inflation is still last year's story.
There really are no real problem areas underlying our data that we're seeing.
Right now, the evidence suggests it's an economy that's pretty resilient.
We've already realized a 50 basis point reduction. We're probably going to realize 2 more 25 basis point reductions this year.
We've got to reconcile ourselves to the fact that we've now got a normal, good economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now with your equity market shaping up as follows on the S&P 500. Equity futures down by 0.2%. We're off by about a third on the NASDAQ. On the Russell, the small caps down by about 0.5%. Still sitting very close to all-time highs with bank earnings just around the corner. The calendar for earnings on Wall Street shaping up as follows. Later this hour, JP Morgan and Wells Fargo. Tuesday, Bank of America, Goldman and Citi. Lisa, on Wednesday, Morgan Stanley.
And the focus is twofold. On one hand, it's net interest income and how much do the loans kind of end up performing less or delivering less as interest rates come down. And then there are the credit concerns. How much was Ally Financial really the canary in the coal mine in terms of credit concerns, credit deterioration coming down the pike?
JP Morgan already warning, essentially, that analysts were too optimistic around net interest income. That was Dan Pinto back in September, 0.1. Ally Financial, 0.2. Then we had David Solomon over at Goldman warning about trading revenue as well. So just lowering the bar going into these numbers.
With a complete lack of visibility. And that is what I've heard from a number of executives in the banking sector. You can talk about pipelines, but in reality, they dry up as quickly as they come out. And right now, there is just a complete lack of visibility about what actually will get done. How much does this have to do with the election? How much does this have to do with some of the geopolitical overhang that seems to be whipsawing some valuations, at least over the past couple of weeks?
Big story for us later this morning. Here's another one in the bond market. Yields just a little bit higher, up 2 basis points on a 2-year, on a 10-year up by about 3. Still north of 4% on 10s, just south of that level on 2s. But a big rally yesterday, particularly at the front end of the curve. Yields were down about 6 basis points. Still working through that economic data of yesterday, the wrong kind of upside surprise on both CPI and jobless claims.
Yesterday was a fascinating litmus test because essentially this was saying what's more important to this Federal Reserve? What's more important to this market? Is it inflation or is it the labor market? And what ended up happening is both were important, but for different reasons. What you saw was basically more rate cuts being priced into the market by the Federal Reserve because of what we saw with the upside surprise in the jobless claims. But on the flip side, longer-term inflation expectations ticked up. You saw that in the break-even rates. We're talking about potentially higher, stickier inflation over the long term with a Fed still willing to cut rates in response to a weakening labor market.
So let's just sit on the front end. What's more important to the market is what's more important to the Federal Reserve. And there is this belief that jobless claims will be more important to the Federal Reserve, even if we can just dismiss them and talk about the hurricane effect. And I think that was reinforced, almost cemented by some of the commentary we got yesterday from Williams, Goolsbee and Barkin, all cementing the idea the Fed is comfortable with this disinflationary trend, just removing some of the emphasis away from that hot inflation print.
Basically talking about how a lot of data will move around, but they have confidence that they are gradually moving back down to that 2% level. It doesn't concern them. It doesn't move them away from necessarily cutting by 25 basis points. Raphael Bostic opened the possibility that maybe, just maybe, he might not want to cut rates in November. That's the reason why in the market, you could see a little bit of skepticism with not even a full 25 basis point rate cut being priced into Fed fund futures.
CPI yesterday, PPI a little bit later this morning, 8:30 Eastern time. Look out for that data. Equity futures, as I say, pulling back by around about 0.2% on the S&P 500. Yields drifting just a little bit higher, up by 3 basis points, 4.09%. Coming up this hour, we'll catch up with John Stoltzfus of Oppenheimer, remaining bullish on equities. Melissa Seixas of Duke Energy, Florida, on the aftermath of Hurricane Milton, and Gerard Cassidy of RBC as big bank earnings kick off later this hour. We begin this hour with stocks on hold as earnings season kicks off on Wall Street. JP Morgan and Wells Fargo set to report later this morning. Oppenheimer's John Stoltzfus writing, we expect investors to pay particular attention to the big banks this season for quarterly results and any guidance. That could provide greater clarity into the health of the US economy, what lies ahead and how it might affect stock prices. John joins us now for more. John, good morning.
Good morning.
It's good to see you, sir. Good to kick off the morning with you.
Great to be here.
How low is the bar for these banks after the guidance we got in conference season a few weeks back?
You know, I think that the bar is relatively low for the banks. I think there's an understanding that is beginning to flow through the markets that this is a period of transition. I think the numbers that we saw in terms of the economy from the July jobs number and then the most recent jobs number, the disparity betwixt the two the inputs that are put into the economy. It's never very clear when you're coming into a transition, into a normalization, or whether you're getting into trouble.
Do you think these bank stocks can perform well with the implied rate path from the Federal Reserve and the SEP a month or so ago?
I think they can. And I think that banks today are more efficient than they've ever been before. It doesn't mean that you can't get a disappointing quarter. And I think the markets always, when they come in here, very often ahead of the reporting, the markets weaken somewhat. Then if we get some results that are better than expected, who knows what the traders will do? Will they say, oh, it's already done, and what's going? But generally speaking, you know, the financials have done very well this year. And a lot of that is the implication that things are getting better, even as things remain quite uncertain.
To build on what John was getting at, there is a feeling that, yes, it potentially becomes more difficult to make the same kind of net interest income as the Fed cuts rates. That doesn't seem to concern the markets as much as the Ally Financial issue. The potential of credit deterioration among consumers that might be beginning to feel the pinch of some sort of change in cycle. How much do you think that's really the concern that people have that could potentially shake some of the confidence?
I think that is one of the major concerns, but it's quite normal that you'll feel that concern at a time when you consider the Fed is what we had 11 rate hikes, nine pauses at the high level before the first cut. And then questions related to inflation being stickier than may have been anticipated before, but likely the hurricanes are likely to ameliorate that somewhat. But overall, you know, what really has amazed me is, you know, 41 years in this business, I've gone through, I remember when Volcker was in his second term is when I came on, is that when you get to this kind of a point, I've never seen the consumers so sophisticated relative to other periods. And a lot of that could be the dissemination of information, the digitalization process of shopping and comparison shopping. I recall on a prior visit, we were speaking about consumer discretionary stocks and how within the retailers, you just have to pick the ones that navigate this current period better than other ones, whether they have greater buying power than the smaller discount stores or what have you. And the American consumer is remarkably resilient. The jobs number is resilient. Earnings have been resilient. Let's see how this third quarter comes out. You know, as you're talking, I'm thinking of someone who we spoke to yesterday from Bank of America who is talking about the resilience of the consumer and how you see ongoing spending in certain discretionary areas. In the past, historically, banks were a leading indicator for the other sectors that might be reporting earnings. Do you think this time around, if they're better than expected when it comes to consumer performance, they also will be sort of a leading indicator for the rest of consumer discretionary? I think they should be. It's just that there are so many more inputs today than we've had in the past. And a lot of that has to do, again, with that resilience of business. So when you look across the sectors and you see what's working with consumers, and you look at the businesses that come in and out of favor quarter to quarter, sometimes day to day with the traders, but there's a general trend that's showing. There's an amelioration process, a digestion of the interest rates, and there really is a sense that people have more money sloshing around in their savings accounts in different places than many people have anticipated. 57.80 at the close yesterday. Yep. Your price target's still 5,900. Well, it's S&P. Yeah, John, it's still 5,900 and will be until the S&P closes at or above it, because that's our discipline. That's our self-imposed discipline. So help me understand where you want to be in the equity market with that in mind. Yeah, with that, we wanted still cyclicals over defensives. It doesn't mean we don't own defensives, but we overweight the cyclicals. Continue to like technology, communication services. We like consumer discretionary, industrials, and financials. Within cyclicals, let's just work through that. The financials, where do they fit into this? I think the financials fit in because eventually we think that net interest margin is going to work for them. Once you get there's some volatility in the yield curve that occurs the way things are going in a transitional period. But once we settle to a more normalized yield curve. I think the banks, once the consumer feels more confident, we'll have to see what later on today we get the consumer sentiment number that comes out later on today. And it'll be interesting to see. But the consumer can be very emotional on those readings when the university reviews, does its surveys. Consumers can be pretty fickle. Remember, they warmed up for a while. The Conference Board was negative for a while, and they got warmed up a little bit. University of Michigan has gone back and forth.
Yeah, I love this. If they called me or you, John, they definitely would get emotions. We would sort of express how we feel about inflation going further out. I just want to finish with this idea of whether, if rates stay where they are, long-term rates, we're not talking about short-term rates, do you think that it favors one sector over the other? Do you think that it favors the ongoing cyclical kind of rotation that we've been seeing? I think it does favor the cyclical rotation, and I think there's a realization that's beginning to come through. But it's still flowing through, is that we're not going back to see the Fed, unless we have a crisis, an unexpected crisis, we're likely not to go back to that band of 0 to 0.25, but more likely in an environment that'll keep the 10-year Treasury, at least near term, with all the changes that are happening in terms of the reindustrialization in the United States and in different countries, the process of diversification, of globalization, the expenses related to that. I bet you, in our view, we'd say that the 10-year will probably be in a range in terms of price to yield somewhere between 3.4 to 5 for quite a while.
Okay. Somewhere around that right now. John, appreciate it. Thank you, sir. John Stoltzfus there of Oppenheimer. I think we all agree on that. Nobody wants rates to go back to zero, because if rates go back to zero, we're in a bad place in the global economy. We get some numbers from JP Morgan a little bit later this hour. You'll hear from Wells Fargo as well. We just heard from BlackRock. Record AUM. Lisa, 11.48 trillion US dollars. Which is sort of shocking. Think about how shocked people were about 8 trillion. That was about a couple of years ago. The estimate was $11.2 trillion. They exceeded that. What is most interesting to me, and this just shows how much money has flooded into U.S. equities in particular, equity net inflows of $74.1 billion. The estimate, $29.5 billion. That just gives you a sense of how much this has exceeded this cash wall. Fixed income net inflows, $62.7 billion. The estimate, $58 billion. I mean, it just shows everything just exceeding that. And so they're capturing that picture from the other side. It speaks to equities being close to all-time highs. On the S&P 500 right now, just a little bit softer, down by close to 0.2%. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
10 people in Florida are dead and more than 3 million are without power following Hurricane Milton. Authorities warn it could take days to assess the full extent of the damages. They are cautiously optimistic, though, that it won't reach the levels of Hurricane Ian in 2022. Governor Ron DeSantis said Florida avoided a worst-case scenario, with the storm surge only half as high as forecasters had feared. AMD suffering its biggest stock decline in more than a month yesterday, falling more than 4%. At an event in San Francisco, it unveiled new AI chips. Investors, though, had also been hoping for new information on customers and financial performance. AMD has been emerging as one of the biggest challengers to NVIDIA in the AI processor market. Shares are up more than 11% this year. And John, as you mentioned, BlackRock pulling in more than $160 billion of client cash to its long-term investment funds this quarter. That means its AUM has been pushed to a record $11.5 trillion in assets, easily beating analyst estimates. They're now looking to become a one-stop shop for stocks, bonds, and private assets, benefiting from this year's surge in stocks and cash flowing into fixed income and private funds. And that's your brief, John.
Phenomenal numbers. Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, determining Hurricane Milton's damage.
Right now, we need to make sure that in the 72 hours after Milton has hit and it has departed, we have to make sure that people are really careful about trying to get back to their homes.
That conversation up next. Live from New York City this morning. Good morning. Earnings from JP Morgan, Wells Fargo later this hour could be about 30 minutes away. Going into it, the scores look like this on equity futures on the S&P, down by a little more than 1/10%. Under surveillance this morning, determining Hurricane Milton's damage.
Right now, we need to make sure that in the 72 hours after Milton has hit and it has departed, we have to make sure that people are really careful about trying to get back to their homes. They need to heed the warnings and communicate with local officials, because this is where we have a lot of deaths occur when the storm has departed.
So here's the latest this morning. Local and state officials assessing the scale of damage caused by Hurricane Milton. The state reporting at least 10 people were killed and 2.5 million residents remain without power. Accuweather's Bill Wadell joins us now from Siesta Key, Florida. Bill, good morning to you, sir. What's the latest?
Good morning to you from a very dark Siesta Key. We are in one of those blackout areas with no power. This is where Hurricane Milton made landfall. You can hear the roar of the generators behind us, and sadly, you can see families' furniture out on the curb waiting to be picked up and heading to the dump for the second time in the span of about 2 weeks. Some of these families lost everything on the first floor of their homes, this storm surge and flooding damage here in Siesta Key. And what we want to point out is the tremendous economic toll that we are seeing from these back-to-back storms. Accuweather has issued a preliminary estimate for the total damage and economic loss for Hurricane Milton, and we are looking at $160 to $180 billion in damage and losses.
And the cost is only going up. Bill, appreciate your time this morning, sir. Stay safe, as always. Bill Wadell there of Accuweather on the latest. That cost is getting bigger and bigger and bigger.
And the difficult aspect is, how do you protect yourself against these storms when it's unclear exactly which aspect of them is going to be most damaging? With Hurricane Helene, it was the flooding. With this particular Hurricane Milton, we see that it's the wind as well. So how do you gird yourself at an infrastructure level for a multifaceted threat that is always somewhat of a surprise?
Let's talk about some of the power issues as well. Melissa Seixas joins us now, the president of Duke Energy in Florida. Melissa, welcome to the program. Fantastic to get some time with you this morning. We've talked about the power outages we've seen across your state. Can you tell us now how many customers are still without power this morning, and how long does it typically take to restore it?
As of this morning, we have about 845,000 customers without service across the 35 counties that we serve. The hardest hit county is Pinellas County, which is located between Tampa Bay and the Gulf of Mexico, just north of where Hurricane Milton made landfall.
Melissa, when you look at how long it takes to restore power, what position were you in coming into this after Hurricane Helene? Were you in a position where you had restored power to all those customers previously, or were you still playing catch-up even going into this?
We had completed our restoration for Hurricane Helene. On Saturday, the hardest hit Barrier Island customers we were able to restore on Saturday. And by Sunday, we were already in full activation for Hurricane Milton.
Melissa, can you give us a sense of what goes into reactivating energy? Is it basically picking up downed lines? Is it rejiggering the circuitry so that you can redirect electricity to new areas? Can you just give us the sense of how much manpower is involved?
It does take a lot of all hands on deck, I will say. And so from a resource standpoint, it's very diverse, because we need line workers, we need a lot of vegetation management. You mentioned the wind takes down a lot of trees. We also need damage assessment, which was a really critical step in our restoration process that we began yesterday as soon as the sun came up. Getting eyes out in the field, both on the ground and from the sky, to help us determine the extent of the damage. And then that informs and shapes our work plans for each and every day. But we've got about 16,000 resources here in Florida to respond to our customers and get them re-energized. And we start with the most critical customers, hospitals, 911 stations, water plants, those kinds of facilities. But I want to really emphasize, we conduct damage assessment along with restoration at the same time. And sometimes it's actually not so much just re-energizing line, but it's rebuilding, especially with hurricane force winds from a Category 3 hurricane. But these are highly skilled workers. we focus on their safety, the safety of our customers as well. So concurrent to all that work happening, we are really stressing and emphasizing to our customers to remain very steadfast in staying away from downed power lines, always assuming that they are energized. So there's a lot of moving parts underway, and we expect to see a number of our customers restored today. And in fact, we will, by the afternoon, provide our customers with an estimated time of restoration so that they can make proper plans.
Melissa, I'm sure it's been an insane and exhausting number of days and actually weeks as you've been responding to all of the subsequent hurricanes. I'm just wondering, as you reset, when this is over, when power is restored, what does the business look to do to try to fortify some of the energy lines for the next prospective storm and the one after that?
We here in Florida are certainly in a constant state of hardening our grid. We're able to do that through what is called the Storm Protection Plan here in the state of Florida. So we have installed over the last handful of years a variety of hardening on our grid, from substation flood mitigation to converting some overhead lines to underground. Stronger poles, stronger wire. We have already seen that pay off immediately. I'll give you an example. In hurricanes Ian and Nicole and Adalia, excuse me, we were able to prevent about 200 million customer minutes of outages. So a lot of preventative outcome from these investments, and we will continue to do that. We take lessons from every single one of these events. As you mentioned, Helene was a very different storm in many ways because of the storm surge that it created up and down the Gulf Coast in our service area. This is the flooding you're seeing to the south of us, unfortunately. And Milton was very much a wind event as well. With those winds coming across as a Category 3. So we've seen a lot of poles down, wires down, definitely flooding in some areas. Fortunately for our service area, we did not sustain the significant storm surge that we had seen in Hurricane Helene.
Melissa, appreciate your time this morning. We know how busy you are, attempting to restore power to all those customers. Thanks for making time for us. Melissa Seixas there, the president of Duke Energy Florida. I think your last question, Lisa, an interesting one for the long term. Do we have to rethink how we distribute power across many of these places?
Especially when you have potentially wind, you have potentially water. In some areas, you've got earth shaking. I'm talking about California. At what point do you have to fortify and harden all of these lines at the same time that everyone's saying that rebuilding the grid and building it out is actually the preeminent concern to making sure that we can advance technologically in the way that a lot of people are talking about?
Think how tough it's been for these residents over the last week or so. They'd only just restored power to all those residents over the weekend from Hurricane Helene. And then Hurricane Milton hits just days later.
Every single commentary, this is the worst case scenario. This is our nightmare. This was actually the bad situation that we were hoping to avoid. The one saving grace is that you didn't get another flood kind of come in some of the same areas in the same kind of way. But it really highlights, is this an aberration or is this a new normal? And what does that look like in terms of longer term planning for some of the regions that are going to be hardest hit? I also thought yesterday we had a really interesting conversation about the flood plans and how they are all dated back to the 70s. And how do you bring them up to speed so that we understand which zones are actually at most risk if something like this were to happen?
We saw jobless claims yesterday, maybe with a hurricane influence. I just wonder how long it's going to shake with the jobless claims we're still to see in the next few weeks, particularly for that payrolls report on November 1st. That one could be so messy after some of these numbers we've already seen.
And so at what point does the Fed look past this? At what point do we start to hear in some of the rhetoric from Fed officials like we did yesterday, our goal is to gradually move down, and right now, maybe data dependency looks a little different than it has in the past.
They're going to have a lot to confront come November 7th at the next Federal Reserve meeting. Up next on this program, Elon Musk unveiling Tesla's robo-taxi called Cybercab. We'll catch up with Bloomberg's Trey Trudell in just a moment. From New York City, this is Bloomberg. Bank earnings in America just moments away. Numbers from JP Morgan, numbers from Wells Fargo, potentially in the next 15 or 20 minutes. Going into it, equity futures right now on the S&P pulling back by 1/10% through Thursday, still on course for a fifth week of gains on the S&P 500, the longest weekly winning streak going all the way back to May. In the bond market yesterday was pretty confusing. A pretty bad data mix. Claims were soft, CPI was hot. So where do you put the emphasis? You put the emphasis where you think the Fed will put the emphasis, and that's on claims. And the front end of this bond market made a move. Yield to lower, a break of 4%, Lisa 397.85 this morning.
Basically, the implication by the market and reinforced by a lot of Fed speak is that the Fed's going to put a greater priority, a greater weight on a jobs figure and any sign whatsoever that there's any kind of weakening. What I thought was interesting is then you see, okay, inflation expectations tick up, so the long end should really rip. And we had a sense that maybe the auction would be a difficult one, the 30-year auction. Guess what? We had record foreign buying. We had record indirects. So basically, this was an incredibly strong, robust auction. Lots of people wanted to buy long bonds. Put that all together. If you're just as confused as I am, welcome.
Had a decent reprice of the long end, 1, 2. I think the beauty of bond markets is that the front end of the curve, the Fed has control over. That's basically the reaction function, how they respond to incoming information. That's what the Fed and the market were looking at yesterday. 1, 2, you can have a real debate further along the curve. If they're going to do X because of Y, what does it mean further out along the curve? And I think that's where the inflation conversation becomes a little bit more interesting.
And basically, people can't decide. They don't know. And that's what you see in Fed fund futures that are highlighting this sort of uncertainty. You see that with inflation expectations, break-even rates down the line, creeping higher. And then people saying, but I kind of like the yields. I'm not that worried. And so they go buy long bonds. Put it all together. It's kind of a soup right now as people look for clarity.
Let's get out of the soup and get into the FX market. I'm not sure if that's more helpful or not. Let's turn to foreign exchange. I want to look at DXY and look at how we closed yesterday. The dollar index closing stronger for a 9th consecutive day, the longest daily winning streak going back to April 2022. Just a little bit of weakness on the screen right now, but over the last week, some real strength.
Basically, what you're looking at is people pricing out the prospect of really aggressive rate cuts simply because the economic data has been so strong. I wonder how much this gets exacerbated next week if the ECB, as expected, cuts rates by 25 basis points and indicates that they're going to go further, because then all of a sudden it is the whipsaw opposite of what so many people expected just a couple weeks ago.
That meeting a week yesterday. So next Thursday, look out for that. Potentially a 25 basis point rate cut. To Lisa's point, the data's not been great. I'd be fascinated by what the excuse looks like at the news conference if they don't reduce interest rates. The dollar right now just a little bit softer, down by not even 1/10%. Under surveillance this morning, China expected to announce the release of as much as 2 trillion yuan, or $283 billion, in fresh fiscal stimulus this weekend. A Bloomberg survey finding most investors anticipate the funding will come in the form of government bonds. The bar for Chinese officials getting higher, it seems, after the monster rally we've seen over the past few weeks.
What I'm most curious about is not the amount of money, not the headline amount, but where that money is put toward. Are they going to build more bridges to nowhere and support property valuations? Are they going to do some of the other fiscal expenditures that people are looking for? I wonder how much that's going to determine the sense of whether truly this administration wants to support the economy and engender some sort of domestic demand, or if it's sort of trying to make things look better ahead of next year.
The CSI 300 has been all over the place. It closed lower again today. Chinese equities down by about 2.8%. Elsewhere, authorities warning it could take days to assess the full extent of the damages from Hurricane Milton. The storm leaving at least 10 dead, and PowerOutage.us showing about 2.5 million homes and businesses across Florida remain without electricity. Elsewhere, Tesla CEO Elon Musk revealing prototypes of the long-awaited Cybercab robotaxi, but the presentation lacked technical details, with Musk hedging his bets on the leap to full self-driving and a production timeline.
We expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes, but in 2026. So, yeah, before 2027. Let me put it that way.
Craig Trudeau joins us now from Bloomberg. Craig, let's go through that line. I tend to be a little optimistic with timeframes, almost hesitant to say, but in 2026. So yeah, before 2027. How optimistic is that timeline?
Yeah, I think optimistic is putting it lightly, because, you know, just as a good example, I mean, almost 7 years ago now, in late 2017, we saw Elon take the wraps off of a next generation roadster sports car we're still waiting on that one. So, and that of course is a vehicle that we humans will actually drive, and so it's kind of all manner of products that you have to be careful with Musk giving timelines. But I think particularly with respect to self-driving and autonomy, this is a topic that really divides investors, where some are keen to go along for this ride of his many promises that he's yet to live up to. Others are really nervous about the fact that he's sort of gone all in on this and done so at the expense of cheaper Teslas that the company desperately needs to grow again.
The stock is down this morning by close to 6%. I can't say that without acknowledging it absolutely ripped off the April low on the back of this announcement that we would have a robo-taxi day. It was up by something like 70% from there before yesterday. Craig, when you think about how much has been baked into this story, can you walk me through the competition and whether you believe this is a winner-takes-all scenario? We've got Waymo, we've got Cruise. Cruise has had its issues. We've got this, whatever it's going to be in the future, Craig. Who's in the lead right now?
That's such a difficult, question to answer because, I do think when you look at, what's actually on the roads and who's actually deploying, I think you have to say Waymo is the clearer answer. When you kind of take stock of how Waymo is getting there and what the sort of state of the business model is, it becomes a little bit fuzzier, right? Because the cars that it is deploying are in select areas. They're very expensive, and that's always been Musk's sort of counter, right? Is this idea of you can't achieve this technological breakthrough that's going to be required without putting millions of cars out on the road that are all learning. And he's sort of making a bet that he can get there over time and turn those cars into self-driving, or get them to the point where we can check out, where we don't have to pay attention. He has not been able to actually follow through on that, and there are some real doubts as to whether or not he has the sort of hardware necessary to pull that off, and whether approach like Waymo's that is expensive for a good reason.
All I can say, Craig, is that if he's looking for extra income, he should open up this particular set to parents with their children on a rainy day and charge them admission. And I think that he would do very well. I am curious about some of the details that Elon Musk did not really lay out, including any kind of addressing the regulatory overhaul or regulatory types of frameworks that would be necessary to really get a self-driving fleet of cabs or cyber trucks or whatever. And the other question really is just whether they would oversee this cab system or this van system, or whether somebody else would. Which of those do you think is most important for investors to understand?
Yeah, I mean, there's sort of questions galore left unanswered by this event. I think it was a slickly staged event, but that's what it was, right? It was a lot of theater. And I would say, in terms of answering your question, I would say the regulatory one is the most important here. If you look at another competitor in this space, Cruise, the unit of General Motors, they had a really hard time getting regulatory approval for a dedicated vehicle that they wanted to make called Origin. And you have limits as to how many cars you can make that don't have a steering wheel or pedals under U.S. law. And so the company ended up going in the direction of, rather than making that dedicated vehicle, just sort of retrofitting an electric car that they already have in the market. And so, whether Tesla can avoid, the pitfalls of what GM went through, Waymo has not tried to go down that route. They've retrofitted other companies' vehicles that have a steering wheel and pedals, even if they're not being used. So there's real questions as to whether or not, they can sort of pass, this company can pass muster. And we know how Musk tends to deal with regulators, which is pretty, in a sharp elbowed way.
Craig, appreciate the update, sir. Thank you. That's one way of putting it. Craig Drew down there of Bloomberg out of London. That stock is down by something like 6%. The earnings this morning, JP Morgan, Wells Fargo, just moments away, both expected to report by 7 a.m. Eastern time this morning. Gerard Cassidy of RBC joins us now for more. Gerard, net interest income, the guidance that we're looking for from JP Morgan, how low is the bar for them that they reset themselves back in September?
It's interesting, John, that as you pointed out in September, they talked about the consensus estimate for net interest income for 2025. They thought was too high. And that number at the time, John, was $90 billion. Today, when you look at the consensus, our number included, it looks like it's 88 to 89 billion. So it's been lowered slightly. I don't expect JP Morgan to give us guidance in 2025, but during the question and answer period, I do expect them to be asked, what do you feel about the new consensus number? And I would not be surprised if they still say it's on the high side. So as you know, they did extremely well in rising short-term interest rate, that environment. And they have always pointed out, in a falling rate environment, their net interest income would come under pressure. And that's what we're expecting to hear today.
Gerard, who do you think it will benefit? When you start to think more deeply about the relationship between rates, what may or may not happen at the Federal Reserve, who will it benefit as well as hurt?
Yep, it's the $64,000 question, John, and it's the right one to ask. And I would say that it's going to benefit what we refer to as liability-sensitive banks. What that means is those are the banks that their funding costs reprice faster than their asset yields. And when you look at some of the regional banks, banks like Fifth Third or Truist, those are two examples of liability-sensitive banks. Bank America is also, as you might remember, when rates were moving higher, they had the long duration bond portfolio, and they were criticized for that, and the stock really didn't perform well. They too should probably see a benefit. On the asset sensitivity side, it's harder to say who's going to be hit the hardest, because if you're asset sensitive, your assets are going to reprice faster, and in a falling rate environment, you really don't want that to happen.
Gerard, it strikes me that there are a number of different banking issues that people are curious about, and they're not all going to affect each bank in the same kind of way. I'm just curious, based on the fact that we're looking at how interest rate income is going to really adjust based on rate cuts. We're also concerned about the consumer based on Ally Financial's warning. Which bank do you think is going to be most interesting, most instructive in terms of these trends?
Lisa, it's a good question, because net interest income is a very challenging line item, if you will, for outsiders to predict, due to the fact that there's so many moving parts. To your point, you have falling rates, or rates are changing. You could also see an increase in loan demand, which will impact net interest income. The banks also use derivatives to hedge this line item as well. So it's very challenging, but I think what you're going to find, to your question, banks like Wells Fargo, JP Morgan, both who are reporting today, Bank of New York already reported. These companies will give us good insights to what they're seeing in net interest income. And most of the banks have a good understanding. Regions Financial does a very good job explaining their derivatives portfolio. On the credit side, we're going to watch consumer very carefully, because we have to ask ourselves, was the Ally Financial warning on credit about a month ago, is that idiosyncratic to them? Or is there a new trend developing? Right now, we think it's idiosyncratic to them, but we'll certainly hear about the consumer today from JP Morgan as well as Wells Fargo.
When those numbers drop, Gerard, we'll come straight back to you. Gerard Cassidy of RBC is going to be sticking close. JP Morgan, Wells Fargo, just around the corner, with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Warren Buffett can now take his time revealing trades in Bank of America. Berkshire Hathaway stake is now just 9.99% of shares outstanding, just below that 10% regulatory threshold that requires rapid disclosure. Instead, Buffett can now provide quarterly updates. Berkshire has reaped about $10.5 billion for sales of Bank of America. Even with recent disposals, Berkshire does remain the bank's biggest stockholder. A management shakeup at Stellantis. The car maker is replacing its finance chief. It's part of a broad management overhaul. CFO Natalie Knight will leave the company and be replaced by Doug Osterman. Knight, who joined the car maker last year, faced backlash over last month's profit warning. It came just a week after she characterized the company's full-year margin target as ambitious. Shares of Stellantis down 3.4% in the Italian trade. The Boeing strike now heading into its fifth week. The company is taking a harder line, with union reps filing unfair labor practice charges, saying the other side has bargained in bad faith and undermined its own deal. The union has said it's willing to talk, though Boeing, quote, needs to meet us at the table, and urged CEO Kelly Ortberg to insert himself more directly into the process. And that's your brief, John.
Danny, thank you. Up next on the program, earnings season kicking off on Wall Street.
I actually think the market is a little bit complacent on credit. I think that what they're pricing into bank stock is this perfect manifestation of a steep yield curve, where deposit costs are coming down, loan growth is going to come back.
Results from JP Morgan, up next. under surveillance this morning. Earnings season kicking off on Wall Street just moments ago. Numbers dropping from JP Morgan and Wells Fargo. Shanali Basak with us around the table. Shanali, let's start with JP.
Well, first thing, you have JP Morgan's net interest income coming in above expectations. Remember, just weeks ago, they guided that the street was too optimistic for next year, but this year still looks good. However, the provision for credit losses also came in higher than expected. So here come the questions about credit quality. The quarter included a $1 billion reserve build as well. So we'll have a lot of questions about that outlook. Remember, Jamie Dimon has been kind of warning about skepticism over a soft landing, worries about next year. But then you also have investment banking coming in higher than expected as well. Of course, JP Morgan, a behemoth in every major business line in investment banking. So that is a positive, especially because typically you don't get those deal fees until those deals close. So the fact that it looks this good right now is pretty positive.
Stock is up by 0.1%. This is always the case with JP Morgan numbers. The numbers drop. You've got to look at them, and then you've got to chase the squirrel that Jamie Dimon starts talking about. Large fiscal deficits are a critical issue. We'll get to the squirrel in just a moment. Lisa, let's start with the numbers themselves.
Yeah, what's interesting to me is that it's sort of the opposite story than what a lot of people expected. Net interest income actually came in better than expected. We also saw this pretty much in other areas as well, like BlackRock. However, the provisions for credit losses ticked up. And to me, the idea that it's the exact opposite problem. It's actually that Ally Financial on the margins was setting the tone maybe in a better direction or a worse direction, but a more accurate direction than some of the net interest income issues.
This is where things were set up coming into this. It was Ally Financial 1. It was the words of Dan Pinto 2. The words of Mr. Solomon over at Goldman Sachs as well 3. They'd all set the bar that much lower going into this report.
Well, remember also, JP Morgan heading into this report is trading at almost 2 times its book value, right? We're seeing pretty record levels of where its stock has been trading. And in addition to that, something to consider, and this is why they're setting expectations so firmly here, the returns on tangible common equity coming in at 19% is well over what was expected. It was 28% last quarter. And so this normalization and what you're seeing in profitability of the banks is pretty interesting, especially considering JP Morgan is the behemoth. There's one more point I'd want to make on this. JP Morgan, fascinating analysis by Morgan Stanley. A lot of their loans are floating rate. So as rates drop and as the interest rate picture changes, they're actually net, according to Morgan Stanley, a negative here because they would have a negative impact from those floating rate loans. When you see those provisions for loan losses starting to build, you start to ask more about those credit card books. We didn't ask about that a whole lot over the last couple of years, but people are maxed out on credit across the entire country. How fast does that turn?
You know, I have to wonder what's signal and what's noise. With credit build, that's partly also the executive management and how they're looking at potential risks down the pike, as much as it is about current risks that are building. And so I do wonder if you pair JP Morgan with Wells Fargo, for example, where provisions for credit losses were below expectations at $1.07 billion versus the estimate of $1.34 billion, but they missed a net interest income. This is a motley picture that has to come down to execution and risk management expectation going forward.
Well, what's the cost of that net interest income, right? Risk. And so when you see them take those provisions, it's at the benefit of that higher net interest income. But then, you know, you have to make that income. You can't lose too much money on it. For Wells Fargo, they don't have that credit card book that JP Morgan has, right? That behemoth credit card book. By the way, Sapphire Reserve, right? A lot of these customers are not low-income, middle-income customers who have been struggling through this environment. They tend to be wealthier customers.
We've got Gerard Cassidy standing by over at RBC. Gerard, let's start with JP Morgan. What's your first take this morning?
The first take, John, is that the revenues are better than expected, as you pointed out, which is positive. The provision was a tad higher. But what's fascinating about the numbers is that the capital levels for JP Morgan are extraordinarily high. They have over a 15% CET1 ratio, common equity tier 1 ratio. As you guys have been discussing, their return on tangible common equity, very high. So overall, it looks like on the very first quick take, the numbers are slightly better than expected. And again, it will be more on the Q&A period during the earnings call that we'll find out more about that 2025 number.
Gerard, can you put this into perspective in terms of what this bank, JP Morgan, has done in the past going into periods of potential turmoil or lack of clarity? In other words, is this a provision build something that is normal, something that is analogous to things that we've seen in previous years, or is this unusually large?
Actually, it was slightly higher than our expectations. We were at 2.9. It came in, it looked like at 3.1. And so it is a very interesting point, though, that you're making, because what we anticipate is credit costs are normalizing. We have to remember that following the pandemic, for a couple of years for JP Morgan and his peers, the credit costs were extraordinarily low. And when you look at the level of credit costs today relative to other time periods, they're very manageable. And the important part is what you expect for the economy in 2025. And so if you're anticipating a hard landing, then this could be the start of something. But we're in the soft landing camp. You saw the employment picture numbers over a week ago, very strong employment still. So we're in the view that the credit picture for JP Morgan and others is quite healthy.
I do wonder if this is a luxury of being the world's biggest bank, or if this is something that we're going to see repeated at other banks. Based on Wells Fargo, we saw actually provisions come in lighter than expected. How much do you attribute this to their not being able to lend maybe on the riskier side, or not being able to extend as much the way that JP Morgan does? And how much do you think that this just highlights that JP Morgan is sort of doing its own thing and sort of preparing for something that maybe other banks aren't seeing?
It's interesting because Wells, as you point out, they've got the asset cap that's still in place. And it certainly does make it more difficult for them to grow their loan portfolio. And therefore, you could argue that maybe their portfolios could be in better shape. But I'd point out a couple of things. First, commercial real estate, when you take a look at the deterioration we've seen, it's been very manageable for Wells Fargo. And the other important point is that, the banks have been de-risked. Remember, they go through the stress test every year, and the regulators are very tough. So the industry today versus 2006 or 1989 or 2000, any of the periods where we went into hard landings, the industry today just doesn't have the risk that it had in those past periods. Now, don't get me wrong, we'll see some credit problems, but they're going to be very manageable this cycle, we think, because we don't see the hard landing over the next 12 months. But all the banks, I think you're going to see, Lisa, we're going to have good credit numbers, even though they're starting to normalize. But overall, we don't see any mass deterioration in credit.
It's a big theme to watch this quarter. Gerard, appreciate your time as always, sir. Gerard Cassidy there of RBC alongside Bloomberg Sonali Basak. This number won't be lost on anyone. Lisa, full year net interest income. This is what JP Morgan's seen now, about 92.5 billion. They had seen at about 91.
These are incomprehensible numbers. These are massive, massive numbers that would be the luxury of any other institution or even government at this point. I am wondering how much JP Morgan's build of capital is just because they can. And so why not build a fortress that can withstand anything at a time of uncertainty and not necessarily a signal of any kind of weakening that they're seeing in the
Analysts
real
were too optimistic, apparently, coming into these numbers, and then they just beat expectations across the board.
You love this game, don't you? Lower the bar, then absolutely blow it out of the water, celebrate it, everybody's excited. You love it.
Drives me nuts. The stock is up by 1.8%. Up next on the programme, Kevin Gordon of Charles Schwab, Bloomberg's Joe Matthew, Savi Syth of Raymond James, and John Lovallo of UBS. We've got a lot to work through from New York City. Earnings season on Wall Street is underway.
Inflation is still last year's story.
There really are no real problem areas underlying our data that we're seeing.
Right now, the evidence suggests it's an economy that's pretty resilient.
We've already realized a 50 basis point reduction. We're probably going to realize 2 more 25 basis point reductions this year.
We've got to reconcile ourselves to the fact that we've now got a normal, good economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Earnings season is underway on Wall Street, live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. We've had numbers from JP Morgan, had numbers from Wells Fargo. The week ahead looks like this. You'll hear from Bank of America, Goldman, Citi, all on Tuesday. On Wednesday, you'll hear from Morgan Stanley. We need to start with JP Morgan right here, right now. I'll make it very simple. Net interest income, B. IB, B. Equity sales and trading, B. Lisa, fixed sales and trading, beat.
With massive numbers that are off the charts, a real question here with net interest income at $92.5 billion versus the expectation for $91 billion. The one question mark is about the provisions of credit losses. A real question mark here about what JP Morgan is seeing down the pike, or do they just have the luxury of stockpiling lots of cash just in case?
So I said when the numbers came out, there's two things you have to do with numbers from JP Morgan. You look at the results, and then you start chasing the squirrel, like a golden retriever on financial news. Jamie Dimon's got this to say. Several critical issues remain, including large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. While we hope for the best, these events and the prevailing uncertainty demonstrate why we must be prepared for any environment.
So I spoke with Jamie Dimon this week, and what really struck me was his emphasis on his role as a risk manager. And what I find interesting is that JP Morgan has the luxury of being the ultimate risk manager, that whatever may happen, should there be nuclear war that breaks out, should there be some sort of massive spike in interest rates to 8%, or if interest rates go back down to zero, they need to be prepared. So there's this question of how much is this a luxury of JP Morgan to be an ultimate risk manager at a time of great uncertainty versus any visibility into something really massive coming down the pipe.
So this is a really important distinction. Often when we get these kind of words come from Jamie Dimon, people start talking about predictions of economic hurricanes and things like that. This is about putting a bank in a position to deal with anything.
That is basically the way he seemed to be framing it, that this isn't about something that he sees that we don't. This is about his job going to the board and saying, whatever happens, JP Morgan will survive. And so when we look at these numbers, it's important to wonder, is this really JP Morgan saying that this world is about to fall apart? Or is this a JP Morgan and a Jamie Dimon saying, look, we have the luxury of being the world's biggest bank. We're not going to fail, and we're going to make sure of that no matter what happens.
Based on these numbers, this world is not falling apart. This stock is up by close to 2% in the pre-market. The broader market looks like this. Equity futures just unwinding this morning's losses, just about unchanged on the session on the S&P 500. We'll keep one eye on the bond market all morning. Yields higher again after moving lower yesterday. We're up by 3 or 4 basis points. The 10-year getting closer and closer to 4.1%. Later on this morning, 8:30 Eastern Time, PPI. Look out for that after a hot and expected CPI print just yesterday. Coming up this hour, we'll catch up with Kevin Gordon of Charles Schwab as JP Morgan kicks off bank earnings. Savi Syth of Raymond James with airline earnings already underway. And John Lovallo of UBS as home builders face a devastating hurricane season. We begin this hour with JP Morgan kicking off bank earnings. Numbers coming in better than expected from that bank and not too bad from Wells Fargo either. Kevin Gordon of Charles Schwab writing, the soft landing is a process, not a destination. The US cannot be in a soft landing forever. At some point, the economy either goes back into a firm expansion or a recession. Kevin joins us now for more. Kevin, it's good to see you.
Good to see you. Good
JP
morning.
Morgan behind us, Wells Fargo behind us. Nothing to see here. Everything's decent.
Well, it's, never a nothing to see here thing. We've got the rest of earnings season to go. But I think that, the important part for earnings, maybe not just this quarter, but as we start to turn the quarter into 2025 is what does guidance actually look like? Because you look at estimates for the overall S&P 500 for next year, for next calendar year, they're pretty lofty, they're pretty elevated. And I think that becomes probably more of the needle mover in terms of this equity market, because when you look at, across an array of valuation metrics that we track, whether it's price to earnings forward on a trailing basis or it's price to sales, we tend to look at a sort of a blended growth rate of earnings, 4.5 years of trailing, versus, with 2 quarters of a look ahead. When you use that metric and you go back into the full history of the S&P, there's only 2 periods where you've been more expensive, and it was the late 90s and it was 2021. Not to say that we're about to repeat what happened after those periods, but there's not as much juice to squeeze out of that valuation or the multiple expansion part of this market. So I think earnings need to do a lot more heavy lifting as we turn the corner into 25. So that's why I think the guidance piece becomes important.
And yet here we are, JP Morgan beating expectations, even as the C-suite attempts to lower the bar only a month or so ago. Just how low is the bar for this earnings season?
You know what's interesting about lowering the bar or moving the bar is that when you go, nobody wants to go back to the pandemic, when we turn the lights off moment. But at that moment, rightfully so, companies at a record pace had withdrawn guidance altogether. And as we've gotten back to somewhat of a normal environment, there seems to be, sort of a more of a near-term bias in terms of companies letting us know where estimates are actually going to be. So there's not as much of this look-forward period where analysts can confidently say, here's what the estimate is, and we're not really going to adjust it more. There's a lot more of an adjustment going on as you get closer to the actual earnings results. So if that's the environment moving forward, which I don't think is a terrible thing. It just makes it a little bit harder to see where the bar is sort of in real time. I sort of think of it in similar terms for monetary policy and where global central banks are. I think because we're in a more supply constrained and, a supply constrained environment where supply shocks have become more frequent and a little bit more, detrimental to the global economy.
I'm just wondering, just to build on this idea of a lack of visibility and how the bar might be shifting around quite a bit. I mean, that's what we were just talking about with the idea of credit provisions, and every company is going to deal with that lack of visibility differently. As an investor, what do you do if an increasing number of companies don't give guidance or give you a huge range or just highlight the black box moment that we're in?
I do think it means that, in general, investors probably have to lengthen time horizons. It's just not as beneficial anymore to be as near-term focused. And for our investors, broadly, we've got over 40 million clients at Schwab. So in general, we think it, tends to be, a better thing to lengthen time horizons. Of course, it depends on, your goals as an investor. But I do think that is the case moving forward, especially even if you just look at this quarter and the rest of this year, evidenced by some of the data that came out yesterday with jobless claims and what we're probably going to see for the October jobs report. Impacts from Helene, impacts from Milton, impacts from anything union related or strike related. All of that sort of makes the data into the end of the year pretty murky. And I think even for payrolls itself, we're in the survey period now for October payrolls. So if there is a bit more of a hit because of some of these shorter term impacts from climate or from anything strike related, you're not going to get a full picture of that until early December when we get the revisions for October.
What strikes me about what you just said is you need to lengthen your time horizon. It strikes me that visibility doesn't get so much better when you start talking about 2025. John's been talking about this a lot. It sort of gets incredibly cloudy with policy as a question, with the question of the geopolitics of the moment and what kind of inflation we end up seeing. How much do you have a longer-term outlook that is solid at a time of such binary potential risks?
I think it's more so lengthening in terms of being able to withstand volatility shocks, where you're not in an environment where you can readily, nobody can forecast perfectly, but you're not in an environment where you can readily see what these supply shocks are going to do on a short-term basis. And I think evidenced by what's happened over the past 4 years, where we have been in a supply shock-prone environment, whether it's the pandemic itself, whether it's what happened with Russia, Ukraine, whether what's going on in the Middle East right now, that's all really tough to sort of decipher in real time. So lengthening the time horizon means being able to sort of take a longer-term approach in withstanding those volatile shocks.
I'm going to shorten the time horizon aggressively through to year end, maybe the next couple of months. The average stock, as you've pointed out, is starting to perform just a little bit better. At the index level, even though we're grinding out record highs more recently, it's been a bit of a grind over the last few months. How do you change your approach when the average stock starts to do better, but the index level gains are a little bit more muted?
Well, it's fascinating because so far, almost to the first half, when you compare the first half to the second half to the day, when we flip the calendar the second half of the year, the market's activity has been almost the opposite, the mirror image of what happened in the first half. Where the first half of the year, you had all this churn and rotation, really aggressive rotation under the surface, but as you mentioned, now it's been a little bit more of a grind. I find it interesting that, when we were looking at all-time highs for the equal-weighted S&P, which preceded the most recent all-time highs for the cap-weighted S&P, that to me is actually indicative of a healthier environment. The fact that by the end of September, on a rolling 2-month basis, you had a record percentage of companies in the S&P 500 that were outperforming the index. On a trailing 3-month basis, it was close to a record. So there has been this really significant lift in participation and breadth and momentum down the cap spectrum in the so-called average stock, while the mega caps have taken a step back. It's almost the flip of the duck market that we were pointing out in the first half of the year, where everything was sort of looking calm on the surface, but then under the surface, you were sort of paddling like the Dickens. Now it's a bit of the opposite, where volatility has come up to the surface. And even though that's been rough at times, especially mid-July to early August, I think it's a better environment because it shows you that things have improved, in the X-Tech or X-Communication Services part of the market.
We don't count record highs on the equal weight. It's just not that interesting to many people. Is it going to become more interesting? Are you seeing clients participate in that story, that theme, a little bit more?
I think it becomes interesting from the standpoint of assessing market health. I think most people still do look at cap-weighted indexes, but our message has been, and to your point, this grind higher, it's probably going to look less exciting at the cap-weighted index level than it would at the average stock level. But I think a lot of that is driven by the fact that, when you look at the bull market's about to turn, to technically tomorrow. First couple of years of this bull market, this has been the weakest run for equal weight relative to cap weight in history. It's been the worst run for the Russell 2000 relative to the S&P in history, and that's following a non-recessionary or recessionary bear market. So I think when you take that into account and the unique nature of this cycle, there is a lot more catch-up to do down the cap spectrum, even within an index like the S&P 500, all large cap companies, but not all have sort of been created equal in terms of their performance into the beginning of this bull market. So because of that, and I think in sort of alignment with our view that the economy is not slipping into recession imminently, there is more runway for those companies. But the differential between what's happened at the mega cap level and what's happened sort of in the average stock world is still pretty wide. So that catch-up probably caps you a little bit and puts you in a more tepid gain situation for the cap-weighted index, but still puts you in, I think, a better situation for the equal-weighted index.
Some of us find it incredibly exciting when the equal weight reaches a new record high.
How many records this year?
What, equal weight? There are 44 on the S&P.
There you go.
All right, moving on. I do want to ask Kevin, just want to finish up here with this question about the appetite for risk among a lot of investors, which is another way of saying they care about the equal weight. I think, you listen to Jamie Dimon. He's talking about large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. How many of your investors feel the same way and actually are a lot less bullish than you would want them to be over the longer term?
You know what's fascinating and been fascinating about this, the post-pandemic cycle that we've been in, and one of the many reasons that it's unique in nature and unlike anything we've seen, at least in modern history, is that there is at times this huge gap between attitudinal measures of sentiment and behavioral measures of sentiment, where on the attitudinal side, you might see folks or hear folks, and we hear it all the time because we're on the road a ton, saying, I'm quite bearish, I'm worried about this laundry list of items, the election being one of them, geopolitical crises being one of them, deficits and debt being up there as number one. But on the positioning side, they're not making as much adjustments. And I think that's really fascinating to me because when you look at extremes in the sentiment environment, when you're in a bear market, and you go back to a period like June of 2022 when you had that first whoosh down in the bear market, there were almost a record low percentage of bulls in an attitudinal sense, but you weren't seeing it reflected in positioning yet. That didn't happen until the October low. So those points, I think, are important to distinguish, especially when we're in an environment like we are today, where people might say they're bearish, but when you look at the positioning and look at their equity exposure, it's still relatively high. Household stock exposure, depending on which metric you use, is right near an all-time high. So until that starts to change, then I think you can say that we're in alignment with sentiment, from a behavioral sense, lining up with what we've seen in an attitudinal sense. But I think right now, it's definitely something to worry about from an unsustainable perspective if you talk about deficit and debt, but it's not yet being reflected in what investors are doing with their money.
Thoughtful. Kevin, it's good to see you. Appreciate it. Kevin Gordon at Charles Schwab there. The latest for JP Morgan, that stock is up by close to 2% in the pre-market with an update on stories elsewhere, including the bank results with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Yes, some details on those bank earnings. JP Morgan and Wells both reporting both shares up 2% for JP Morgan, 3% for Wells. JP Morgan's third quarter results beat across metrics. It upgraded its forecast for net interest income for the entirety of the year, too. CEO Jamie Dimon said the bank will maintain its pace of buybacks with results backed by a strong balance sheet. At the same time, Wells Fargo did report a miss on net interest income for the third quarter, but profit was boosted by a 37% jump in investment banking fees. Former President Donald Trump is making a bid to boost the auto industry. In a speech to the Economic Club of Detroit, he promised to make interest on car loans tax deductible. He also promised to renegotiate the U.S.-Mexico-Canada trade agreement to prevent Chinese cars made in Mexico from crossing the border. He also took a swipe at his host city, saying the whole country will end up like Detroit if Kamala Harris is elected president. And this year's Nobel Peace Prize was awarded to a group of atomic bomb survivors in Japan. In a statement, the Nobel Committee said the organization was selected for the prize, quote, for its efforts to achieve a world free of nuclear weapons and for demonstrating through witness testimony that nuclear weapons must never be used again. The award comes with an additional prize of just over $1 million for the organization. And that's your brief. John.
Very cool. Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the cost of rebuilding.
There's going to be a need for significant amounts of money. We're already underway at trying to calculate what the cost will be because we don't want to mislead anybody. We want to make sure all the costs are able to be covered.
That conversation up next, live from New York this morning. Good morning. Bank earnings underway on Wall Street. Just heard from JP Morgan about 20 minutes ago. That stock is higher in the pre-market by a little more than 2%. Lisa, it's a beat across the board.
Pretty much, with $92.5 billion of net interest income. A huge question here about whether this is a bank girding for an upswing in the economy or a downswing or both. Basically, they have the luxury of doing whatever they want. So if they build more credit losses, is this really a sign for other banks, or just why not do it because we got the money?
Got to look for other banks. Tuesday, Bank of America, Goldman, Citi. Wednesday, Morgan Stanley. That's the calendar for the next week or so. Under surveillance this morning, the cost of rebuilding.
I think the Congress should be coming back and moving on emergency needs immediately, because this is going to be a long haul for total rebuilding. It's going to take several $1 billion. It's not going to be a matter of just a little bit. What we're providing now to make sure people have the emergency relief they need. There's going to be a need for significant amounts of money. We're already underway at trying to calculate what the cost will be, because we don't want to mislead anybody. We want to make sure all the costs are able to be covered.
So here's the latest this morning. President Biden urging lawmakers to return from recess as Florida faces a long road to recovery. House Speaker Mike Johnson's spokesperson saying coming back to Washington would be premature. Bloomberg's Joe Matthew joined us now from the nation's capital for more. Joe, why does Speaker Johnson's office think that it would be premature? What's behind that?
You know, he was talking about this on Sunday morning, Jonathan, saying that they need time to come up with estimates, as the president was just saying. They want real numbers here that they can write into legislation and present to lawmakers. And he suggested that wouldn't really be done until they could come back after the election anyway. But the calls are growing louder here, not just from Joe Biden. I spoke yesterday with Kathy Castor, a congresswoman from the district that includes the Tampa Bay area. She joined me by phone because she's one of the more than 3 million people without power. She's making that call, as is MAGA Representative Anna Paulina Luna. This one really got our attention yesterday. Also a representative from Florida and a Trump ally here says that Congress should go into a special session. We can get it passed immediately. This needs to happen. Speaker Johnson, call us back. So it's coming from both sides of the aisle here, Jonathan, and it'll be interesting to see how the speaker navigates this over the weekend.
Especially, Joe, because there's the dueling kind of priorities of people's lives, health and happiness, and politicking. I mean, how did they make the argument that campaigning and the campaign trail is more important than getting down to Washington and trying to provide some funding to help ameliorate some of the pain that people are experiencing down south?
Well, you ask a great question. I mean, what would actually be better as a campaign move than to go back to Washington to do the work of the people here? Because that is exactly what members are doing right now. They've got a weekend of events lined up in pretty much every district, town halls and so forth, so they can get their names out there and do the campaigning that needs to be done. But we've got 4 weeks to go here, a little bit less than that. And obviously a trip back to Washington wouldn't take too much time. Again, it might be a week or two before we have real numbers on this. But a lot of experts say this could be handled before the election.
In the meantime, we've gotten a lot of town halls and different meetings and events by the two candidates, Donald Trump and Kamala Harris. What have they been saying in terms of the financing of this, especially at a time where tax cuts and the promises of them seem to be very much on the forefront?
Yeah, to be honest with you, we haven't heard a lot about funding from the two candidates here. Obviously, Kamala Harris is involved in the hurricane briefings and has been speaking from the White House as a member of this administration. But when it comes to the campaign trail, it's really been an argument about mis- and disinformation, with what we saw in North Carolina, to a lesser extent in Georgia and Florida. FEMA is out there trying to debunk rumors. You've got the president of the United States himself fact-checking Donald Trump live from the Roosevelt Room in the White House. I don't think I've ever seen anything quite like that. They're very concerned that people are not getting the help that they need because they're afraid of what they're hearing about FEMA, either confiscating property or selling them short on losses. This is something that runs across the Southwest right now and has been a real concern for people in Washington. FEMA says it not only needs money, it needs an honest shake so it can get help to people where it's needed.
Joe, something important developed on the campaign trail yesterday. It was the former President Barack Obama. And he started to go down a tricky road. And I think it's a very difficult path for Democrats to start going down. Addressing the misogyny within their own party. How are they going to do that in the days and weeks to come?
Yeah, I know where you're going there. That was pretty interesting, indicating that young black men might not be comfortable voting for a woman and pointing to polls that show that many young black men, in fact, favor Donald Trump. I don't know where you get on this. Barack Obama started last evening a series of events in Pittsburgh. He's going to be out for Kamala Harris over the course of the month. When she's asked about this, and she held a Univision town hall last evening, she has said, I'm out here to work for every vote, and I make no assumptions based on my gender or racial identity here. So I guess this is going to be Barack Obama's job going forward. Unclear how it's going to work, Jonathan.
Joe, how simplistic do you think it is to put it down to misogyny and not policy?
Look, this has been a personality contest largely for a couple of weeks here. I don't have an answer to that question. You've got Donald Trump rolling out new tax proposals with 3 weeks and change to the election. Which one works? Which one matters? The fact is they don't know. This is a one-point race or a tied race in every state, basically, that matters here. So both campaigns are trying everything they can to get to the middle. And it's pretty unclear how many people are left in the middle who have not decided.
Looking forward to your coverage, sir. A little bit later, Bloomberg's Joe Matthew out of Washington, D.C. You can catch Joe every weekday on Balance of Power at 12 and 5 p.m. Eastern Time. The former president going down a tricky path.
Especially because this is sort of one thing that Kamala Harris has tried to put on the back burner, making it not an issue about those things and making it more about policy. So does this help or hurt at a time when ultimately, do you want to be focused on policy? Do you want this to be a personality contest? There are a lot of difficult kinds of needles to thread at this moment, just because these candidates are trying to cater to each specific constituency that all have competing potential goals and names.
We want to focus on policy, so we should focus on policy. There's been a few more initiatives being presented on the campaign trail at a time when we have a federal deficit running at 7% of GDP, even though unemployment is around 4% and GDP is running pretty well. It raises questions about what on earth we're going to do when it's bad. What does this deficit look like in bad times?
This is the reason why a lot of people keep raising the deficit and everybody shrugs it off and says, I'll worry about that when I have to. But you start looking at each item, in particular, the former President Trump, because he talks about how you cut taxes when it comes to car loans, when it comes to if you're an expat, if it comes to whether you're a low earner or whether you're a high earner, whether you're a business. So it just raises this question of how much of a priority is this for the two candidates that are going to be facing off with a very difficult situation, given the increasing entitlement payments, given the fact that interest payments are not going down that quickly, as we've seen from the long end of the yield curve, and as it's unclear that ever it's going to be politically palatable to say you're going to cut the deficit and cut spending.
Jamie Dimon's in the headlines a lot. The one thing that I walked away from your brilliant conversation earlier this week, the prospect of the Treasury market trading like a commodity market. If that happens, and you'll get tons of pushback and fixed income around that story, but let's just say, if it happened, if it started to correlate with the cycle in a more profound way, because ultimately, obviously, sovereigns, particularly developed market sovereigns, trade inversely to the cycle. If that started to happen, that would be devastating for the Treasury market, and I think for global markets too.
The concept here is that commodities are a supply and demand story, and that typically commodity markets don't trade until something happens, until there's a catalyst, and that increasingly Treasuries are supply and demand story. And they may not be fully realizing the scope of just how much pain they could really suffer should there be some sort of catalyst.
That's what you buy in bad times. It retains risk mitigation characteristics.
Or does it?
Exactly. That's a big question. Up next on the programme, Savi Syth on the state of the airline industry from New York. This is Bloomberg. Two hours away from the opening bell, equity futures down just a touch. We're softer, negative by 0.1% on the S&P as we count you down to the opening bell with your morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. I want to get us a read on where bank stocks are trading this morning. For the whole, the sector is higher. Earnings this morning, J.P. Morgan 1.7% higher in the pre-market trade, a beat across most metrics. Investment banking, net interest income 3% higher than the year prior, where most banks forecast it being lower. They also upgraded their view of net interest income for the entirety of the year. The one flying the ointment, perhaps, announced those credit provisions higher than expected. Wells Fargo also higher in the pre-market trade, despite the fact that it missed on net interest income, up 3 1/3%. Not only did it miss on net interest income, it downgraded its view for the year, seeing a decline of 9%. Before, they had a range of a decline from 8 to 9%. Perhaps the thing helping it was investment banking fees, up 37% in the quarter, a beat for that metric. Finally, Tesla. It was Elon Musk over the summer that said, if you don't believe we'll solve autonomous driving, do not buy this stock. Maybe the verdict is in, down 6.2%, having their Warner Bros. Unveiling of the cyber taxi yesterday, saying that it would be by 2026 in production. Of course, joked about the timeline and his inability to hit some of those timelines. It would be less than $30,000. So again, shares down 6.2% in the pre-market because not a lot of detail in that report. Perhaps tellingly, both Uber and Lyft up decidedly in the pre-market trade, maybe seeing less competition for them from an autonomous driving taxi from Tesla. John.
Interesting. Danny, appreciate it. Thank you. After a monster rally, 70% off the April lows following that announcement for a robo-taxi event, we pulled back by about 6 percentage points in a pre-market on shares of Tesla. Under surveillance this morning, you heard the numbers from JP Morgan and Wells Fargo are out. They came out in the last hour or so. JP Morgan is higher in the pre-market by 1.5%. Wells Fargo is up by more than 3%. I want to share that quote again from Jamie Dimon earlier this morning. Several critical issues remain, including large fiscal deficits, infrastructure needs, restructuring of trade, and remilitarization of the world. While we hope for the best, these events and the prevailing uncertainty demonstrate why we must be prepared for any environment. You caught up with the man himself earlier this week, and that's almost exactly what you heard.
Basically talking about how he needs to manage risk, and this is a time of uniquely terrible visibility. Not saying that he actually thinks that the economy is going to fall off the cliff. Quite the opposite. He's, still thinks the U.S. is the best place probably for growth and for IPOs and for a whole host of other industries. A real question, though, about whether M&A will be allowed to come back in a real massive way, whether we get tariffs, what that will do, what national security provisions will do, and how this affects businesses that consult with the likes of JP Morgan in terms of what they develop and where. To me, these are all massive questions. And so you do wonder how companies are going to deal with that uncertainty. Will you see other types of cash build or hesitance to engage in big actions because of it?
And this is going to be the big question. Corporate America. What does corporate America do? And then we can get into how the banks are going to serve them. Flying blind into 2025 has been a big theme for this program over the last several months. We're a month away from a really important election. And I think I hear the same boilerplate stuff on the South side that we always hear every time we have an election. Doesn't matter who's in charge, stocks go up, things are going to be okay, doesn't really matter, nothing really changes. Things could change in a profound way based on one outcome versus the other in a month's time.
Which is the reason why, and I do think about this, when people say it's all about the consumer, we hear person after person say the consumer is actually doing just fine. They have a stockpile of cash, et cetera. But when do businesses start to say, we need to be a little bit more conservative? We're not going to engage in massive hiring plans. We've already seen that in some of the hiring numbers. We're not going to necessarily make a big move or attempt an M&A because we just don't know what that framework is going to look like. And when does that actually have an impact on the economy itself?
The latest from some of the big players this morning. More big banks, of course, reporting just next week. Elsewhere, let's talk about some of the Fed speak. Atlanta Fed President Raphael Bostic saying he would consider skipping a rate cut at the central bank's next meeting. Those comments going against remarks from Fed Presidents John Williams, Austin Goolsbee and Thomas Barkin, all of whom indicated rates can continue moving lower. Bostic, the first to say the quiet bit out loud.
Basically, does this really call into question just how quickly and how much we have to cut rates? The interesting thing is, to your point, other Fed officials not saying it at all. And this is what Austin Goolsbee of the Chicago Fed had to say. The overall trend over 12 to 18 months is clearly that inflation has come down a lot and the job market has cooled to a level which is around where we think full employment is. Clearly, this is the key word. And this is what the market had gotten complacent about, that inflation was dead. It wasn't coming back. Now, are you starting to see a little bit of a waking up on the margins when you take a look at break-even rates on the long end?
Worth repeating something we've said earlier this week as well. Raphael Bostic is a really interesting Fed speaker to watch right now. They all oversee different regions, and the regional Fed presidents will oversee different impacts from the hurricanes. Atlanta Fed President Raphael Bostic is sitting right on top of that story right now in the Southeast.
Yeah, and a real tricky issue of just how much the jobs picture is going to be clouded by some of the hurricane influences. We already saw that potentially with the jobless claims, but also what this does to GDP, because ultimately you end up seeing typically growth fall off a bit in those regions and then surge as everything has to get rebuilt. So how do you price that in as a Fed official when you're trying trying to strip out noise and you're incredibly data dependent, you don't have a clear longer term kind of outlook.
You have no visibility whatsoever on the election and what policy looks like in 2025 and beyond. Let's talk about some of those policies. Donald Trump, the former president, pledging to make interest payments for car loans fully tax deductible in a speech at the Detroit Economic Club. Trump also vowing to renegotiate a trade deal in order to prevent Chinese cars made in Mexico from being sold in the United States. I think we have to separate two things: the policy and why we're talking about it, and then the price of it. And I think we should first deal with the policy and why we're talking about it. They will have to discuss this at some point in government on either side of the Atlantic. How are we going to help this industry? They are major employers, both in the United States and across Europe. And particularly in Europe, we talked about this, and we'll catch up with the Stellantis CEO next week. These car companies are in such a bad position in Europe. They have so much excess capacity that one of a few things needs to happen. You cut that capacity aggressively, that will mean job losses, not politically palatable, arguably not good for the economy either. Or you get some help from the state. Now, the president, I think, opening the lid on a much bigger conversation that needs to take place, not just here in America, but also over in Europe.
Yeah, I'm glad that you brought up that angle, because that's what I thought when I read this. I thought to myself, wow, given that Volkswagen came out talking about China sales dropping 15% this morning, given some of the warnings that we've gotten from them, from BMW, from Mercedes, this question of what has to happen to sort of maybe put the thumb on the scale a little bit more for domestic vehicle sales and manufacturing. How much does a government want to get involved with central planning to counter central planning in another region that is doing it pretty efficiently, right? I mean, how much do you sort of get involved and do this? And then I would raise another specter of this, especially as we're talking about the idea of the fiscal deficit. How much room is there to do this? How much willingness will there be by bond markets to finance some sort of incentive program like that to try to get a competitive edge? I'm not so sure.
On top of all the other promises that are out there on the campaign trail right now, at the moment we're running a budget deficit of 7% of GDP in a good time and not in a bad time. Watch this space. Let's talk about earnings from American and United Airlines, still ahead after disappointing guidance from Delta in the last 24 hours. Savi Syth of Raymond James joins us now for more. Savi, welcome to the programme. I'd love to get your thoughts on what happened with Delta and why it only took just a small miss, just the midpoint of guidance coming in below expectations to trigger a bit of a sell-off, particularly early on yesterday. What was behind that? Was the bar just a little bit too high going into earnings?
Hey, John, what I would say is investors are finely tuned to try and figure out, what's happening with the U.S. airlines. You're seeing an industry that was struggling over this summer with too much capacity. And you've seen in very short order as the summer ended, low-cost carriers and ultra-low-cost carriers moving quickly to take capacity out and match kind of supply to demand. And so what investors are trying to figure out is this having an effect? Is this enough that the industry has done so that we can get some margin expansion in 2025 for this industry? And Delta's guide on unit revenue from that perspective left a little bit wanting, and they called out an impact from elections. And so it's a little bit noisy here. And, the stock did recover a little bit. So I think investors are taking it in stride. But there was no clear signal if this is enough changes have been done to drive that margin expansion next year.
Savi, that was a question asked in the newsroom much earlier this morning at a time that you don't want to be awake at. I think it was about 3:30, 4 a.m. And we had people asking the same question, Savi. Was that an excuse, or is that something you typically see around elections? Was it just more pronounced this time around? What was that?
Yeah, you definitely see it around elections. And we've been calling about this year being noisy around, especially this kind of election period. But usually it's within the fourth quarter, and you get a little bit of an air pocket. And if you look at what airlines have done, a lot of airlines have actually reduced capacity the week before and the week after elections in anticipation of this. And it just seems that what Delta is seeing, at least, is bigger than what we've seen in the past. So giving them the benefit of the doubt, they're saying that, the trend, there's a clear break in trend before and after. So there definitely seems to be more of an impact this year than in the past.
Savi, when Delta catches a cold, does the rest of the airline industry have the flu?
Yeah, it's a different position that the airlines are in. Historically, ultra low-cost carriers, low-cost carriers have been much more profitable than they are today. So if Delta is seeing weakness, then in this environment, I think the rest of the industry especially on the low cost and ultra low cost carrier side, does see a bigger hit just because they're not as profitable as they've been in the past.
I ask this, Savi, because this has to go to the gap between people who have higher income and people who have lower income. And traditionally, we have seen that gap between Delta and, say, some of the lower income or the lower cost carriers. And I'm just wondering, do you think that that's the issue here, that this is just a matter of just discretionary spending across the board coming down? Or do you think that this is just having to do with structural gluts and some of the uncertainty that you were talking about that's temporary?
I think the reason the low-cost carriers and ultra-low-cost carriers are in a bit more of an unprofitable position today is just the fact that costs have gone up for this industry. 6 points of margin have been wiped out just in labor costs. And so the ultra-low-cost carriers, low-cost carriers added a lot of capacity coming out of COVID, assuming that this was kind of like a normal recession-type recovery where you could take a lot of market share. And that was not the case. So I think that the airline industry, there's a slight difference here in that they just added too much capacity on the lower end. The industry as a whole, it tends to be kind of middle income and high income households that tend to travel. It's definitely helpful to kind of Delta, United, that higher income individuals are doing better today. So there's a lot more demand for premium. There's a lot more demand for international. So that's definitely helping. But I think on the flip side, there's just too much capacity on the main cabin side, and that needs to kind of get right-sized and not necessarily related to household income spend.
The airline industry is fascinating to me, Savi, because you're looking at the potential vulnerability to different consumer trends, but also to different commodity trends. I'm looking right now at Brent crude, which is up $10 in the past month to currently $78.74 at a time when that's one of the biggest costs for a lot of these airlines. Just how vulnerable is this sector should there be an additional surge in crude prices?
Yeah, Lisa, the one interesting thing is while Brent prices hadn't come down as much, jet fuel prices had come down before last week. And what really drove that is refining margins have really normalized back down to 2019 levels, or maybe a little bit better than 2019 levels. So that has definitely given this industry some breathing room. You're right, it's about 25-30% of their costs. So what happens in kind of the jet fuel market matters for this industry. But at the end of the day, there are very few airlines that are hedged. And so the industry feels the pain the same way. And the biggest tool that they have is to then adjust capacity to kind of meet the new pricing environment that they have to kind of aspire to kind of keep margins higher.
Savi, appreciate the update from you following Delta earnings going into American and United for the next few weeks. Savi Syth of Raymond James on the airlines in America. Winning the morning, Glenn Score over at Evercore. Following BlackRock earnings, a record $11.5 trillion of AUM. Lord of the flows. Do you like that?
Oh, I love that.
That works, right?
That's so good. Honestly, I think that BlackRock, usually you sort of see their earnings and it's like, okay, a lot of it's passive flows. What can we get from it? The passive flows in and of themselves were fascinating. And John Stoltzfus, before he left, he said, it's interesting because a lot of people aren't counting on Social Security being there. So they're saying, guess what? We're going to put our money into something that historically has been a provision of some sort of income. So that's stocks, that's bonds, and that's what you've seen in massive flows that absolutely blew expectations out of the water.
Based on how these campaigns are going, there'll be no tax base. So, yeah, you're damn right we're not getting Social Security.
That's what I find interesting. How much is that underpinning some of the flows that we're seeing in markets?
BlackRock in the pre-market up by 2.3%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israel has stepped up its strikes on Beirut in its campaign against Hezbollah. Local officials said 22 people were killed in a strike on a residential building that was targeted a senior member of the terror group. The strike comes with the country yet to decide how to retaliate against Iran for ballistic missile attack last week. Israel's security cabinet held a meeting last night, but an Israeli official tells Bloomberg it ended with no decision made. One person was killed and 12 others were rescued after an accident at a gold mine in Colorado. Authorities say that an elevator malfunctioned around 500 feet below the surface, trapping the group for about 6 hours at the bottom of the mine. Those who were trapped did have access to water and means of communication. It's the first safety issue at the mine since the 1980s. Officials say that an investigation will be launched. The Yankees are heading back to the ALCS after taking down the Kansas City Royals in 4 games. Jarrett Cole delivered a vintage performance, holding the Royals to just 1 run and 6 hits over 7 innings. They're now set to face either Cleveland or Detroit in the next round, with that series set for a decisive Game 5 tomorrow. And that is your brief, John.
Danny, thank you. Appreciate it. Up next on the program, the rush to rebuild.
There are people lined up down the street and around the corner that will buy back in those coastal communities. It's amazing the type of land rush that happens immediately after a storm.
We'll talk about the home builders up next on the program, live from New York. This is Bloomberg. Earnings season underway on Wall Street. JP Morgan in the pre-market just off session highs, but still firmer by 1 full percentage point every way you look on this business. And the earnings that we got about an hour ago, just a beat across the board, Lisa.
When I was looking at just even things like headcount, up 2% year over year, just to give you a sense of scope of how big this company is. 316,000 employees. That gives a perspective to $92.5 billion of net interest income. These are pretty phenomenal numbers. A lot of focus will be paid to the look ahead, and I think that that's what I'm most interested to hear in terms of the analyst calls. What type of pipelines are they looking at? What type of expectation for businesses? The lack of visibility, I think, was really what came out to me when it comes to some of the credit cost build and some of the other commentary that we heard coming out of the C-suite.
One of, if not the, biggest private employers here in New York City. Equity futures right now just a little bit softer. We're down 0.1% on the S&P 500. Under surveillance this morning, the rush to rebuild.
You will have all of those that saying, you know what, again, I've aged out, I'm gonna move out, but there are people lined up down the street and around the corner that will buy back in those coastal communities. They will build up, they'll build to the higher building codes, and they will make the necessary investments to be able to enjoy what's beautiful about living on the Gulf Coast or the Atlantic coast. It's amazing the type of land rush that happens immediately after a storm.
The rebuild starts right now. Here's the latest. Officials assessing the damage left behind by Hurricane Milton, while analysts begin weighing the impact on the housing market. John Lovallo of UBS writing, while we believe the storm could create a near-term headwind for home builder operations, we view any impact to construction efforts and demand as temporary. John joins us now for more. John, welcome to the program, sir. Let's just start from the top. Which companies, which home builders have the most exposure to this part of the country? One. And two, how much inventory would be at risk going into Hurricane Helene and Hurricane Milton?
Sure. Hey, John and Lisa, thanks for having me. Obviously, a devastating storm and really two devastating storms, and our hearts go out to everyone in the areas. I mean, if you think about Milton specifically, we're talking about 7 of the top 50 home building markets that were in the direct path of that storm. And we're talking Tampa, Bradenton, Winter Haven, Orlando, Port St. Lucie. I mean, you name them, they're all sort of in that path. Now, the big home builders all have exposure in these markets. I would say that from the top, Pulte Group does about 5,000 units in those markets, so call it 17% of their volume. Lennar's at about 9,000, so call it 13% of their volume. And D.R. Horton is at about 10,000 units, which is about 12% of their volume. So very important markets, across Florida for everybody. Obviously, their portfolios are diversified well outside of Florida. And the important point that you bring up as well is, as devastating as this is, and the focus right now absolutely should be on the humanitarian portion, there is going to be an opportunity for all these folks to rebuild, and the builders will have a very nice chance to step in there.
So, John, there's going to be a rush for labor, for raw materials, which raises questions about the price of labor and raw materials. Do they have the pricing power to offset higher costs for labor and raw materials?
I mean, there certainly is pricing in certain markets across the country. Now, keep in mind that interest rates are high, home prices are high. The builders are offering incentives to get folks over the finish line in terms of affordability. So there could be pressure points for sure throughout the value chain. I would imagine that resources are going to be brought in from other areas to sort of fill this. To the extent that that drives up home prices, hard to say. Now, importantly, I think in areas like Florida in particular, the existing home stock, which is very old, we've talked about this on this program before, over 40 years old, the challenge becomes getting homes insured. And I think Jimmy, as you had on the program yesterday, was talking about building codes getting tougher and tougher and needing to get tougher and tougher in order to withstand storms like this. And I think that's where the builders have a real opportunity to put new product in the ground that is going to help withstand some of these tragedies.
When you're talking about all these new provisions, I'm just thinking cost goes up and up and up. I mean, you start thinking about insurance, you start talking about fortifications, you talk about stilts, whatever you need to do to try to prevent real destruction should there be another storm. John, at what point does this flip the script when it came to people moving to the Sun Belt, or in particular the Southeast? If you're talking about the increase in costs, people were usually going for lower costs.
Yeah, it's a great question, Lisa. I mean, at some point it becomes prohibitive, I would have to imagine. However, there are a lot of great things about moving into the Golden Horseshoe or the Sunshine States, whether it's just weather alone, but maybe more importantly is job growth. And that's where jobs continue to move. And there's a lot of reasons from an economic standpoint, but there's also a lot of reasons because people in general like to be in those areas. And this is a trend that was in place well before COVID. The builders will adjust. The builders will figure out a way to put product into the ground at prices that are affordable while maintaining margins and returns. We're very confident in that. Again, the focus now is on just us trying to assess the damage and hopefully hopefully things were a little bit less severe than initially contemplated.
John, you alluded to it. Can you just build on it a little bit more? The prospect of providing a insurance product in some of these areas. How do you think that might work?
That's a little bit out of my sweet spot, John, but what I would tell you from a home building perspective, it's no secret that in some of these coastal areas, whether it's Florida or even parts of California where there's been wildfires and things of that nature, it has become increasingly challenging and in some cases impossible to get homes insured. Now, for Florida and the storms, I think if you think about the older housing stock that's in the market today, that's even a bigger challenge because they just don't have foundations, the windows, the doors, and things of that nature that are built to this higher standard. And so I think that the builders, to the extent that they can do this, and they will, those homes are going to be in a much better place to get insured than something that's been in the market for 40 years.
John, appreciate your time this morning. Lots to work through. John Lovallo there of UBS on the latest with the home builders, particularly down in Florida. Some breaking news for you. So we've said this a million times. It's not really breaking news. Don't get too excited. The S&P 500 market cap weight, record highs so far in 2024, 44. OK, a conversation we had a little bit earlier in the programme, the equal weight argument I was making is the equal weight's not that popular yet because people aren't counting how many record highs we've had. Lisa, take it away.
Kevin Gordon, thank you for this. There have been 20 all-time highs in the equal weight S&P 500. So when you ask me next time how passionate I am about every record high, I will have a tally. I will make a sign. I will hold up that sign and I will celebrate it with all my might.
You're going to be counting from now on?
Absolutely. Okay. Of course I will.
All right, OK. I'll ask for regular updates. Yeah. Up next on the programme, Scott Chronert of Citi, Bloomberg Sonali Basak on the latest bank earnings. We had Wells and JP Morgan a little bit earlier this morning. We'll look ahead to next week too. We'll catch up with Lara, Rhame of FS Investments with PPI dropping at 8:30 Eastern Time. And we'll speak to Leslie Falconio of UBS. All of that still to come in the third hour of Bloomberg Surveillance. With earnings season underway on Wall Street, equity futures on the S&P 500 with the smallest of bounces. We're still lower. We're softer by 0.1%.
We do think we're still in a good is good environment.
The more important thing for risk assets is not whether rates are going up or down. It's what's the broader economic and earnings backdrop.
Maybe there's this narrowness creeping back into the market.
The market is sort of punishing the more expensive stocks for the higher rates.
I think we're in a bull market, and peak inflation, peak tightening, peak rates should be good for equities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We are heading towards 5 weeks of gains on the S&P 500, the longest weekly winning streak going back to May of this year. Equities just off all-time highs coming into Friday. We're softer by 0.1%. The opening bound 90 minutes away, 30 minutes away. PPI after CPI came in just a little bit hotter than expected yesterday. Futures a bit softer here across the board. We had bank earnings earlier this morning from Wells Fargo and JP Morgan. JP Morgan is up in the pre-market with basically essentially a beat across the board. Their stock is up by 1.6%. Coming up next week, we'll hear from Bank of America, Goldman and Citi. On Wednesday, you'll get Morgan Stanley to round out earnings on Wall Street. JP Morgan kicking off earnings season on Wall Street in a pretty decent way.
If you look at investment banking fees, surging 31%. Take a look at equity traders, 27% increase. Net interest income, we've repeated this number many times just simply because it is rather incredible. $92.5 billion, up from the expected $91 billion. Across the board, you see net interest income up. You also see credit provisions along with some pretty dire statements from Jamie Dimon. He has been known to make such dire predictions. What's interesting is that they're stockpiling cash ahead of that. Is that going to be a theme for the other banks as well?
Another theme for the likes of BlackRock, Evercore calling them Lord of the Flows.
Love that.
$11.5 trillion in AUM over at BlackRock. That name up in the pre-market by about 1.8%. We'll talk about them into the opening bell, no doubt. Then the attention starts to shift, to drift back to the economic data once again. A real toxic mix yesterday. Claims higher than expected. CPI just a little bit hotter than expected. PPI, the next stop for this market, about 28 minutes away.
You almost said it was a toxic brew. It was a little bit starting to have that flavor, a question of whether you care more about the inflation ticking up just a tiny bit or whether you care more about the fact that potentially the number that was the biggest jump in initial jobless claims that we've seen going back for a full year, whether that was telling you something other than just noise from the hurricanes. The bottom line is basically the market is saying both, that they're going to see a Fed that is going to look at the labor market, but longer term, potentially that could increase inflation on the margins, which is what you're seeing in terms of break-even rates.
Inflation just looking a little bit stickier. Coming up this hour, we'll catch up with Scott Chronert of Citi as bank earnings roll in. Lara, Rhame of FS Investments looking for the Fed to pause in the new year. And Leslie Falconio of UBS expecting a more bifurcated consumer in the near term. We begin this hour with stocks on hold as JP Morgan kicks off earnings season on Wall Street with investment banking revenue and net interest income beating estimates. Scott Chronert of Citi saying high level, the earnings setup looks solid. Better than expected beats and smaller than normal out-quarter revisions support our earnings resilience thesis. Scott joins us now for more. Scott, welcome back to the program, sir. Let's get into that thesis. Earnings resilience. Is that true for a couple of sectors, a handful of sectors, the whole market? Where's that theme a little bit more concentrated?
John, I think it's true pretty much across the board for every sector, maybe with the exception of the energy component of it. But generally speaking, yeah, it's the same scenario we've been talking for the past 2 quarters. We expect a very typical beat, if you will, with this quarterly reporting period. But there's still enough noise in the macros, geopolitical component of the market that we expect that most corporates will still be somewhat muted with their forward-looking guidance.
Scott, what's generating the beats? Is it better top-line performance, top-line growth rate, just doing a better job than we thought they would do at defending margins?
Yeah, I think you nailed it. I think it's a combination of those. We're still seeing a decent revenue component, but what's happening is that we're still seeing signs of margins improving, particularly at the EBIT level across most sectors. And what that's doing is creating this situation where, in addition, you're beginning to see free cash flow increase quite notably. What this does is open up financial flexibility. So where you get a little bit of a top line improvement, you get a better earnings beat. And then in addition to that, you begin to see corporates still flexing their muscles via share repurchase activity.
Scott, I just want to pick up on what you said about expect a lot of lack of visibility from corporate executives in the earnings in terms of a forward look. That's certainly what we saw on the margins, just slightly from JP Morgan. I'm wondering at what point concerns about uncertainty become reality and a lack of investment, a lack of bold moves, how much you're expecting to see that from businesses that are kind of looking into the abyss of the unknown.
Well, our view on this, Lisa, is that we've been expecting that with the Q4 still containing a number of issues that we're going to need to contend with, and market up 22% so far this year. We do have to expect that we're probably going to get a dynamic where many investors and corporates are likely to be locking it in terms of their expectations for this year. As we look forward to next, again, we still have some uncertainty with the elections, again, geopolitics and underlying macro conditions that are still weighing on the conditions. But all told, when you think of the Fed influence over the past 2 years now, it's very fascinating that we've seen most corporates been able to weather 2 years of a hawkish Fed pretty nimbly, okay? So what we're looking at going forward is this component where, yes, that Fed overhang has probably kept most corporate investment activity somewhat muted. That begins to ease as we go into next year. But all told, what I'd keep coming back to here is that for 2 years of Fed hawkishness, the fundamental improvement through the S&P, particularly this year, is quite notable. And importantly, it's clearly broadening beyond the Mag 7 into, let's call it the other 493, which is how you're getting your incremental index highs here.
That's where I was going to go, actually. We were speaking with Morgan Stanley's Mike Wilson yesterday, and he was saying that he expects that to continue and that actually the places that he expects to be less impressive is probably in big tech that already have had such an incredible string of gains. Do you agree with that? Is that kind of what you're expecting this earnings season?
Yeah, okay. It's really interesting. So if you look at the Mag 7, they're trading, I don't know, top 12th percentile of their 20-year relative valuation history. The other 493 is actually more expensive versus its history right now than is the Mag 7, okay? So there's clearly an element here where the broader market is increasingly paying forward for ongoing fundamental improvement as we go into 2024. With the Mag 7 in this mega cap growth cohort, we probably have more visibility of earnings growth next year. NVIDIA is projected to grow 40%, the rest of the Mag 7 about 20%. On the other hand, Lisa, what's happening with that other 493, we still have not yet found bottom in terms of full year 24 estimates, nor full year 25 estimates. So while 25 is setting up for, we call it a high single digit growth opportunity for next year, you're still seeing this right sizing of estimates under the surface that haven't yet quite found bottom. This is typical this time of the year. We don't think we actually get to that point probably to the Q4 reporting period. So all told, yes, this broadening effect is setting up for next year. A lot of it's getting priced in. That's what we have to be sensitive to, I think, in terms of the playbook into the end of the year.
Scott, if Anne-Marie was here, she'd start asking about the US election. So I'm going to do it for her. The corporate tax rate could drop to 15 with conditions. It could climb to 28. It might stay at 21. I've got no idea. Do you assign a probability to one over the other? What do you do with that?
Well, I think what I would say is that it's a frequent conversation in discussions with clients. You can't get away from the election potential outcomes right now. The race obviously is still quite tight. What we've been doing in terms of modeling this out is exactly as you say. When you look at each of the candidates, in our view, from a fundamental perspective, they're incrementally negative to U.S. equities. Okay, and what you have with Vice President Harris is the risk of a higher tax regime. But again, this requires a sweep more so than a split Congress. With ex-President Trump, we have to navigate tariffs, some talk of lower tax rates, and then a deregulation push underneath that. All told, the way we think it models out is that both are incrementally negative. What we're going to have to keep an eye on, and this is going to be a storyline as we get into 2025, is that, as stated right now, both policy platforms are mostly incrementally negative for the deficit as well. So as we go to next year, we expect the noise level around that to begin to pick up as well. So all told, we think there's lots of discussion around elections right now. I think many people are going to be waiting for post-elections to determine to what degree you want to begin to position for expected policy outcomes.
Let's just give you a hypothetical. Let's say the election happens and suddenly the bond market starts to trade a little bit more like commodities and yields go up significantly on the longer end because suddenly people start to wake up to this idea of a bigger deficit. At what point does that start to crimp some of the potential rally that we would get in equities?
Well, you see where this is setting up, Lisa. It's spot on. So, we're using 5,600 for our end of the year target. We're through that now by a couple of percentage points. So we're allowing that we trade for the most part sideways into the end of the year with more focus under the index surface at the sector level. We can talk about the broadening theme to your equal weight as well. But our setup for 2025 is where we're looking for a more muted upside. So we're using 5,800 for next year. We have a bull case that gets us into the mid sixes, but that's going to require a more aggressive earnings picture than we're projecting right now. So what I would say on this is that coming back to this notion that, yes, we are paying forward for a lot of the expected earnings improvement. That's reflected in an index trading near 24 times trailing. So as we look ahead to next year, the risks that do come out on the policy side post-elections become a little bit more front and center. And what we think that does, when you combine it with the risk of the bond market vigilantes returning after a hiatus in expectation of this ongoing deficit concern popping up, what it does set up for is a little bit more muted upside to the U.S. equities as we go into 2025, despite a decent fundamental background and tailwind.
Can you put some numbers on what makes a bond vigilante? And I ask this because ultimately people have been wondering why yields have crept higher. Actually, they shot higher last week. And it didn't seem to matter for equities that continue to make record highs, including the S&P equal weight that made its 20th record high. How much are we looking going forward at a sort of change in the dynamic? At what point does that trigger some sort of risk-off feeling, even though it might not necessarily come in tandem with weaker data?
The issue that's going to come is the deficit continues to creep higher, right? And with higher interest rates, you get a different setup in terms of your interest expense burden as a percentage of your tax receipts. All of those right now are poised to move higher. Remember, we go into 2025, we're going to kick off with debt ceiling extension. And the expectation there is that that's going to happen pretty naturally, but it's going to begin to bring this issue back to the fore on the heels of the election again. The TCJA expires at the end of next year. So what we have to allow for is that we're going to have literally the better part of 25, regardless of who's in the White House, that we're going to be debating taxes. We're going to be debating how to address the deficit situation. And all of this is going to, I think, keep coming back to this. Now, the good news for equities is when we look at our projections, we expect that for the S&P 500, this is an important nuance, to continue to reduce shares outstanding via buybacks by about a percentage point a year. So the supply of equities continues to come down. As fundamentals continue to improve, not a bad setup from a supply-demand perspective. You can't say that about the Treasury markets. We're expecting ongoing incremental supply of U.S. Treasuries that's going to have to be consumed by the market. And that's going to happen in a context where we're looking at this geopolitical situation globally. And what you have here is a situation where very strong reliance on the dollar maintaining its reserve currency component to essentially maintain the ability for the U.S. government to issue securities. All told, what I'm getting at here is that we think it happens in fits and starts beginning early next year and continues through the end of next year as we're kind of debating tax policy in anticipation of the end of that TCJA expiry.
Scott, a lot of layers to what you just said, and I think what you just said is so important. I myself am going to go home and watch this interview again and go to the very end of it, because there's an extra question I've got for you. If you get this supply-demand dynamic take place in the equity market, Lisa mentioned the bid coming from people who just believe there will be no social security for them. There will be no pension available for them. They'll have to take care of this for themselves in years to come. Can you describe this constant bid, particularly this passive bid that we'll just see in the equity market, this tailwind for years to come?
Well, I think we're probably setting up to see it for years to come. But, John, we got to be careful that we're coming on the heels of a very strong year-to-date equity market performance on the heels of last year's. So while I wouldn't say the equity markets are in a euphoric place, there's certainly a level of confidence out there that you need to be in the U.S. equity markets, okay? And you see this show up in the flows, and you've seen it particularly show up in the flows on the heels of the first Fed rate cut. We're talking about our ETF flow dynamics, and it's amazing the surge that's continued to go into core U.S. equity and growth equity exposures here. So there's no doubt that from a global investment perspective, U.S. equities, particularly S&P, are viewed as a very, very safe neighborhood to be moving into. So we expect that to continue, but we just have to keep in mind that we're being lulled into a security phase here, which has been warranted by fundamentals and by a peaking of Fed. And I'd go back to your earlier comments. When you're looking at coming off of a 2-year hawkish Fed narrative to something that starts out less restrictive, potentially moves a little bit down an easier path, that's hard to fight, right? So yep. We're expecting that the S&P can maintain a higher than traditional valuation setup, premised on much more resilient fundamentals than many would have thought going into this Fed hawkish narrative, a couple of years ago. And all told, what that does do, it does make large cap U.S. equities stand out as we think, a very good place for longer term investments.
Scott, appreciate your time this morning. Super smart, as always. Scott Chronert there of Citi, the latest in the equity market and a nod towards the bond market as well. Bond vigilantes. This is what happens. If we get to a situation where the bond market dictates policy preferences down in Washington, D.C., that's when the vigilantes are really back. If we're just repricing yields higher because CPI is a bit hotter, growth's a little bit better, it's a very different story. If we get a market that basically says, no, you can't do that, and Washington has to respond in turn, then the vigilantes are in a big way.
That's the reason why you need to watch auctions, because that's when they'll show up. It's suddenly a failed auction. What happens if the buyers don't show up? What happens if the banks can't take it all down? All of these questions that send a really strong message that sort of rhyme with the Liz Truss moment. They're not the same thing, I know, because of the preeminence of the dollar, et cetera, but that is the issue.
Very, very different, of course. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. At least 10 people in Florida are dead following Hurricane Milton. Authorities warn it could take days to assess the full extent of the damages. Governor Ron DeSantis said that Florida avoided a worst-case scenario with a storm surge only half as high as forecasters had feared. Israel has stepped up strikes on Beirut in its campaign against Hezbollah. Local health officials say 22 people were killed in a strike on a residential building that was targeting a senior member of the militant group. Last night, Israel's security cabinet held a meeting to decide how to retaliate against Iran for its ballistic missile attack last week. An Israeli official tells Bloomberg that the meeting ended without a decision. Shares of Tesla are down in the pre-market by more than 6%. CEO Elon Musk revealing prototypes of the company's long-awaited robo-taxi called Cybercab. Musk said the car could cost less than $30,000 and production may start in 2026. But investors were hoping for more details. And that's your brief, John.
Danny, appreciate it. More from Danny in 30 minutes' time. Up next, the Morning Calls Plus. Bloomberg Sonali Bassett with highlights from the JP Morgan media call. Their stock is up by 1.3%. One hour and 10 minutes away from the opening bell. Equity futures just about unchanged on the S&P 500. Let's get you some morning calls. First up, Barclays sticking with its equal weight rating on Tesla, saying its robo-taxi event was too light on details. That stock is down by 6%. Your second call from Goldman, raising its price target on Nvidia to 150 from 135 with a buy rating, citing continued AI demand. That stock is just about unchanged. And finally, Evercore, reiterating its outperform rating on BlackRock after earnings, citing strong revenue growth. Lord of the flows, as they called it. The stock is up by 1.8%. Let's stick with the financials. JP Morgan's media call underway after the bank's net interest income beat estimates. Wells Fargo also rising after reporting better than expected profit. Sonali Bassett back with us around the table. Sonali, what stands out on a call?
Well, a few things. They are pretty optimistic about the economy. You have Jeremy Barnum, the CFO, saying that these results are consistent with a soft landing, if not a no landing. And so for, the caution that you normally see from JP Morgan, things are looking pretty good. Even on provisions, they said this is really a factor of them really expanding their revolving credit card balances. So they're leaning in. But like I said, they said that things are pretty okay in the economy here. They're still a little uncertain about the geopolitics. The last thing they said, I would say, too, is they're doing better than they expected on trading and investment banking. And so it's interesting, and for Wall Street, it's nice to see that they're making money in this volatility, because sometimes when you saw what you saw in August, that could be gapping. It could send people away, but people are clearly leaning in.
Let's put a finer point on what you just said. The caution you typically associate with JP Morgan is the caution we typically associate with Jamie Dimon himself, and more recently, Dan Pinto as well. How do those things stack up, the comments we've heard from the C-suite, with regards to the results we see this morning?
Well, it's incredible. The first two questions on the call were, hey, you weeks ago said things were going to be a little worse. And then they were meaningfully better on every business line that you were talking about. So, one thing the CFO did say, more caution. They think that results will be somewhat challenged as normalization continues, but they stay upbeat. So this is classic JP Morgan. They guide low and they shoot high.
So basically, do people just sort of shrug it off and say, okay, say whatever you want, but clearly you're just making bank? Is that sort of the way that it's being interpreted?
This is the first time in a long time I'm sitting here at earnings with you guys and already turning the page to the next group because it was kind of a boring morning. Everything is a pretty clean read. It's business as usual. Life is pretty good.
All right, so you're turning the page. What are you looking forward to when we get the other bank earnings next week?
I think it gets really choppy when you think about the smaller and regional banks. The numbers in investment banking trading bear really well for Morgan Stanley and Goldman Sachs, which are leaning more towards that, of course. But when you think about the regional system, it's super choppy out there. Remember, we've been talking about how not every bank has the credit card book that JP Morgan has. And you saw, for example, at Wells Fargo on the revenue lines, that was really the only place you saw growth. You saw home growth, but only off of really low levels. Auto was tough. Personal lending at Wells Fargo was tough. So where are these banks going to get interest income in the face of lower interest rates?
The future of Wells Fargo in someone else's hands, the regulator. Where are we with the asset cap?
Very uncertain still. It seems like it's just around the corner and we reported as much, but at the end of the day, until it's done, it's not done, right? And so one thing that's interesting about Wells Fargo is I think that this is a classical American banking story. More and more banks getting out of core American lending businesses and into big Wall Street businesses. You're seeing Wells Fargo make that shift truly. You're seeing it in the stock paying off as well because it's not like their net interest income beat, but they did beat in those Wall Street businesses.
Interesting. Shanali, Katie, Matt Miller coming up in about 35 minutes' time to count you down to the opening bell. Look out for that. More bank earnings, of course, in the next week or so. On Tuesday, Bank of America, Goldman Sachs and Citi. On Wednesday, Lisa, we'll hear from Morgan Stanley.
Yeah, I'm actually very interested in Bank of America for a number of reasons. First of all, because of some of that legacy book of treasuries and just how much it's getting less onerous as time goes on. But also, Warren Buffett selling out of a lot of his position in the stock. A real question about why? We don't have a sense now, under 10%. So a real question of whether they kind of subtly address it in any time as they try to give some forward-looking picture about maybe why their largest shareholder has been cashing out.
Next up for this market, PPI in about 5 minutes' time after hotter than expected CPI just yesterday. Together with what we saw at jobless claims, the wrong kind of upside surprise there as well. 1 hour away from the opening bell, waiting for PPI. We're going to be catching up with Lara Rhame of FS Investments, Leslie Falconio of UBS also here to react. Equities going into all of that, just about unchanged on the S&P 500. In the bond market, holding on to 4. On a 10-year yield, we're up by another 3 basis points to 4.09%. A break of 4 and a 2-year yield just yesterday following that economic data I mentioned. Yields climbing just a little bit higher, up a single basis point, Lisa, to about 3.97.
Yeah, today will be really interesting with PPI coming in just a few moments, as well as University of Michigan sentiment survey. What happens if sentiment deteriorates and PPI comes in hot? How much does that start to change the narrative just a little bit more?
I still love that we phone people up and ask them their inflation expectations for 5 to 10 years out.
But not you.
I still love that. I'm still waiting for the call myself.
Yeah, but people are fickle, we learned.
I don't know how you put a number on
Emotional. Well, what do you think it's going to be? 10.
10. I think there's a big difference between what it is and what they tell us it is.
Yeah. Oh, you're one of those. Flat earther.
"60 minutes away from the opening bell, seconds away from economic data. PPI in America just moments away after getting CPI come in just a bit hotter than expected in yesterday's session. The scores look like this. We're negative by not even 0.1% on the S&P 500. On the Nasdaq 100, we're down by about 0.2%. In the bond market, the 2-year yield up by a single basis point to 3.97, up by a couple of basis points on a 10-year, still north of 4%. With that PPI data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, this is the opposite of what we had yesterday with CPI. This comes in lower than anticipated, flat for the month-over-month gain. The forecast was for 0.1% gain. Ex-food and energy, 0.2, which is what was forecast, but final demand for ex-food trade and energy, the sort of super core of PPI, up just 0.1%. So that puts us on a year-over-year basis at 1.8%. which is obviously base effects because that goes up from last month for the headline. For the core, 2.8%. That's also higher than anticipated in last month, and 3.2% for the super core numbers. The overall numbers that we care about or that are going to make a difference is that the index for final demand services rose by 0.2. Goods declined by 0.2. So at this point, it's kind of following what we had seen before.
The smallest move off the back of this, Mike. We just about turned positive on the S&P 500, positive by not even 0.1% after being down by not even 0.1% going into the numbers. If you look at the bond market, we give up some of the move at the long end of the curve and then take it back again. The 10-year up by 2 or 3 basis points to 4.09%. Really muted price action off the back of this.
You know, I think about when you're in a room and you see lots of shiny things, and the more that they put in there, the more you just start shutting down and you don't see anything. It sort of feels that way a little bit with economic data as it comes out, and it's kind of noisy, and it's getting noisier, and it's getting even noisier, and suddenly people are like, really, what am I supposed to do with this? And that's a little bit what this feels like. Okay, does this negate what we saw yesterday? Well, does it all just matter about PCE? Either way, it seems like it's not rocking the boat too much.
I think what Chairman Powell said back in 2023 in August, navigating the stars under cloudy skies, I think that still holds, Mike McKee, right now. It's difficult to know what to put weight on and what to ignore.
Yeah, I think basically what the inflation numbers over the last 2 days are saying is we're still on course. It's a little bit higher yesterday, as you said, a little bit lower today as we go forward. What's interesting is that final demand services was where we saw inflation in this. And what story have we been talking about all morning? JP Morgan doing very well during the last quarter. Well, the index for deposit services rose 3%. So banks helping push the PPI up to the extent that it rose.
I want to dig in a little bit further. You said that services, you did see a bit of a gain there, and goods, a little bit of a decline. I do wonder how much you are seeing on the margins any kind of shift in that dynamic. In the CPI report yesterday, we did see that with food and some of these other areas that hadn't been inflationary, becoming inflationary once more. Is there anything like that in PPI to confirm that we're kind of reinflating certain areas that already had been on the disinflationary side?
Yeah, I'm not really seeing anything in this. When you look at final demand for this, the PPI has 3 different indexes in it, but when you look at final demand for goods, less food and energy, it was up 0.2%. So final demand food up 1%. So yes, food was pushing us a bit higher this last month, and take that out and you have a much better inflation picture. Now we'll have to see why that was and what it means going forward. Nobody's had a great explanation other than maybe there was some hurricane-related stuff or port-related stuff, but it could be just a random move, a one-off. We'll have to see next month on that.
No drama on PPI this morning. Let's cross over to Lara Rhame of FS Investments. Lara, let's build on the conversation we were just having with Mike McKee, and welcome to the programme. CPI and jobless claims out yesterday, PPI this morning. I think we're all having some difficulty understanding what to ignore and what to pay attention to. Help us out.
I think that's been made even worse by the fact that we got a higher than expected initial claims number, clearly because of the disruption of these natural disasters that are so devastating to small areas of the economy and can have a big impact on the data. I think, it's really the payroll report, the CPI report. Within that, we are seeing just this continued stubbornness in the inflation picture. I think Mike's right. We're on track, certainly for the Fed to continue to ease rates in November, in December. But there's a stubbornness to the services side of this. I think it's one reason why today, too, the PPI numbers maybe didn't make as big of a splash. Goods prices are back in deflation. We know that. The inflation, I think, trouble is really still in the services piece. It's maybe trouble's too strong. It's like a mild headache that still isn't going away.
Well, Lara, how big a gap is there between the way you see it and the way the Federal Reserve seems to see it? Because we heard from Williams, Goolsbee and Barkin, and they seem to cement this idea that for the Federal Reserve, at least, they're comfortable with this disinflationary trend still holding.
I think maybe I'm a little bit more concerned about inflation, and I'm concerned about it in the short term simply because I know we are going to have some data disruptions that are going to maybe, create the noise in the food data, create the noise in some of the, prices that we're seeing with cars. But I'm also concerned about it in the medium term. I'm looking ahead to some of the factors that I think in the middle of next year are going to give us stubbornly higher rent inflation. You know, I don't know how far you want to look out, but when you put it all together for the Fed, they're having to navigate their dual mandate in an active way that they haven't had to in decades. We were either only worried about growth or we were only worried about inflation. Today, we're kind of worried about both the jobs pictures and inflation. And I think it's going to make us all really zero in on data and be more uncertain about the Fed's trajectory.
Lara, there was a signal in yesterday's trading action that I thought was really important, which is that the bond market was looking at the prospect of a Fed cutting rates even with inflation reads that were messy, that did come in hotter than expected, with still some uncertainty about that path of disinflation. Lara, from that perspective, do you think, based on Fed comments, there is sort of a tacit understanding in the market and on the Fed that they will tolerate a higher inflation rate going forward in order to keep any kind of weakness from getting a hold of this labor market?
You know, I think they have to because, you know, inflation was so far below target for years leading into the pandemic. I think it's natural, given their average inflation target over time, it gives them the latitude. And I think that's on purpose to, you know, accommodate, make policy more accommodative, even if it's a little hot. You know, it's not a bad migraine like 9% inflation back in 2022. It's a chronic headache, but I think it still gives them the room to maneuver. And if they go 100 basis points in total this year, that still leaves rates in restrictive territory. I just think they pause at the beginning of next year and reassess where things are going because I don't think inflation is going to follow the neat path like it did before the pandemic.
When you put this all together, does it make the bond market look more or less accurate on the long end in terms of reflecting that there is more flexibility when it comes to inflation rates and the Fed's response mechanism?
I think it makes the bond market look way more correct for the first time in a long time. The market has been trying to push in too much policy accommodation into the forward curve. They've been making that mistake for 2 years now. So this isn't new. I think what it changes is that, you know, thinking about Fed rate cuts, we're kind of trained to think, oh, the whole interest rate complex is going to continue to fall. In reality, the 10-year falls a lot before the Fed cuts rates, but what it does after the Fed starts cutting rates really depends on the trajectory of the economy. If the economy doesn't go into recession, the 10-year kind of floats back up again. I think that's what we're seeing, and it's a reflection of a solid economic base and only an incremental slowdown in growth.
Bond yields resumed the climb this morning. We're up by 3%, 3 basis points, just took out 4.1% just moments ago. Lara Rhame there of FS Investments. Lara, appreciate it. Up a single basis point at the front end of the curve on a 2-year right now, about 3.97 as we were going into PPI data. With us around the table, Leslie Falconio of UBS. Leslie, welcome to the show. It's good to see you again.
Thank you.
Good to see you in person too. I was going back over your comments previously in the summer, and it stood out to me that you were kind of dead on. This was your call. The Fed will cut twice as the economy slows. Maybe we get another cut, maybe we don't. You said that the 10-year yield would drop to about 3.9%. Basically there, 20 basis points away right now. How have your thoughts evolved over the last few months?
Well, actually, when it comes to the 10-year Treasury, they really haven't evolved that much in the sense that we really do believe that that 10-year will stay relatively range-bound. You know, we know that we've had a bit of rise in the 10-year yield, obviously, given the fact of what we've seen in terms of some of this employment data. But overall, we're really looking for that long end to stay very range, maybe, you know, 380 to 4.25 type range. And actually, we do think that there's actually some value here in that, you know, buying, not necessarily that long end, but around that 1 to 5 year, absolutely.
Just build on what we've heard from the Federal Reserve so far. Your call on the Federal Reserve, has that changed? Because after that 50 basis point move, there was some speculation that maybe the bar was pretty low to go 50 again, and then last Friday happened. Blowout payrolls report, big upside surprise, big conversation, flips the other way. Are we even going to cut interest rates again at this Federal Reserve? Where are you now?
We're still at 5%, right? We still have a long way to go, and they're still normalizing, right? So we do think that they were going to cut. Actually, we still believe that they cut twice this year, 4 times next year. You know, I know there's a higher probability of a pause being put in. I doubt very highly that they pause in November. I don't even put the likelihood of them pausing in December unless they do something like, you know, NQT. Then maybe they could do a pause at that point. But otherwise, we really still think they're on the path to normalizing. We have the terminal rate, whatever that might be, at around, you know, 3.25, 3.5. The market's completely repriced from 287 down to about 335 right now. So actually, we think that the market is, the soft landing outlook that the market's pricing in is really where we're supposed to be.
This feels like ancient history, but I remember a time maybe 5-6 months ago when any time that people thought that the Fed was looking past inflation, you'd see the long end of the curve sell off. You'd see yields go up because people were thinking, okay, well, maybe they have deprioritized inflation and that's going to lead to higher long-term inflation. Is this really sustainable, the idea that that no longer is the case and that people kind of look past the idea of that and just continue to say, like you're saying, you know what, they're so restrictive, it's fine, they can cut a lot, they've got a lot of room?
You know, I don't think so. I mean, look at what happened when they cut 50. Yields rose, right? They did a 50 basis point cut, which was, you know, out of the gate, and yields rose. And I do think that the inflation part, and I do think the curve will steepen, by the way. That's also our expectation. You know, I do believe that the back end will, you know, respond to inflation the same way it responds to higher growth, if in fact we do accelerate. But when you look at things such as the five-year inflation swap, I know you've been talking about the break-even inflation expectations, which are going higher. The five-year inflation swaps are still around a 2.5%. This isn't some large reacceleration, I think, that the market needs to be concerned with. But, you know, it was our expectation that you wouldn't necessarily have a straight line down. You're going to have these smaller kind of blips that we saw in CPI. But overall, reacceleration is not a concern. If that becomes a concern, then you'll see that back end go up.
We were speaking earlier with Scott Chronert of Citigroup, who is an equity strategist and who is focused on the bond market. He was looking to the potential volatility on the heels of the election, really coming from the bond market and trickling out into equities. What are you looking to happen in November?
You know, listen, there's going to be a lot of volatility heading, you know, into November, and I think it really depends on if it's divided. I think it depends on policy versus implementation and the timing. You know, we know that we'll have these knee-jerk reactions, the way we did at the end of June. If in fact it's something like a red sweep, you're going to have a bear steepener, right? If that bear steepener occurs that we feel is going over its skis, we would actually push against it. So I think that's really what the market needs to pay attention to when you're going to have these extremes, but it's not necessarily a go with. Because when it comes to things like the deficit and even supply, at the end of the day, it really depends on what growth and inflation is doing. That's the primary. Supply is secondary. So I think you'll have this reaction, but it doesn't necessarily mean it's a go with.
Let's just sit on that scenario. Let's say we get a red sweep. You get that bear steepener. We start pricing in all of those tax cuts that have been promised on a campaign trail. What kind of number do you step in at? Are you looking for 10-year yields to gap out to 5% again? What are you thinking about?
Listen, during times like that, and we saw this during the June debate, what happened? I mean, you bear steepened like 30 basis points, but then you had a payroll report that came below expectation. You gave it all back. So I think I wouldn't be surprised if you can go easy 30 basis points in the 10-year, no problem, or more. I just don't think it's sustained, and I think that's the key.
Leslie, it's good to see you. Appreciate your thoughts. Leslie Falconio of UBS on the bond market. Lisa, a key topic for you going into November.
Well, this to me has been the topic, that the bond market is a source of volatility, or perceived to be the source of volatility during the election, because that's really going to be the question. Neither of these candidates are promising any kind of reduction in the deficit. If anything, it's deficit expansion. Question about whether there will be volatility, question about do you buy it, do you go with it, and a question around, how much do we not know in terms of the composition and how much that will really change just how significant the reaction is.
This much is how much we don't know, and that's the problem. Let's take the Republican scenario. You get the red sweep, then you get the stuff the equity market wants, the tax cuts. You also get the tariffs at the same time. What you do with that, I don't know. You get the sell-off in the bond market because we're going to be doing nothing with a budget deficit. Yields start to climb. So that's one scenario. Then if you get divided government under a Republican president, then you get in the tariffs, but none of the good stuff. Then you start to think about what it means for the Democrats and Kamala Harris, and it's just as difficult, as complex to figure out.
One big question that I have is, who are each of the candidates going to put in their cabinets? Who are they going to put around them? Because right now, there's a lot of talk, and a lot of it is sort of dismissed as, all right, rhetoric, they're trying to get each individual voter. Who are they going to put around them that's actually going to implement these policies? And that also is a big unknown. So, yeah, it's this wide, and we don't have any promise of it becoming narrower anytime soon.
A lot to work through in the next month or so. Just remember, every time everyone talks about 2025, no one's got any idea what 2025 actually looks like. Equity futures on the S&P 500 right now just about unchanged, with an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Just a reminder, those bank earnings kicking off this morning with JP Morgan and Wells. JP Morgan up to 1.25%, Wells Fargo up 4.3%. JP Morgan reporting third quarter results, a beat across metrics, and an upgrade to its forecast of net interest income for the year. CEO Jamie Dimon said that the bank will maintain the pace of buybacks with results strongly backed by a balance sheet that is also strong. At the same time, Wells Fargo reporting a miss on net interest income for the third quarter. Profit, though, was boosted by a 37% jump in investment banking fees. Food producer Bruce Pack has recalled nearly 10 million pounds of poultry and meat items due to potential listeria contamination. Department of Agriculture officials detected listeria in poultry samples during routine testing. The company's ready-to-eat chicken was found to be the source of the listeria, which may have contaminated other products made from June 19th to October 8th. And game one of the WNBA Finals was one for the ages after a stunning comeback for the Minnesota Lynx. Minnesota rallied back from a 14-point quarter deficit behind incredible clutch performances from Nafisa Collier and Courtney Williams. They become the first team in history to come back from being down 15 points with under 5 minutes left in the game. Game two tips off on Sunday in Brooklyn. And that's your brief, John.
Danny, thank you. This league was given a gift. And this league does not know what to do with it, do they? Ted and Clark, they just don't seem to know what to do with it.
Yeah, they have a star, a real star. And the question is, how do they monetize this renewed interest in the WNBA and the fact that suddenly, female basketball is the hot topic on the sports landscape?
Some of the players resent it. It's been amazing to watch over the last year.
Yeah, well, basically celebrate your stars because that will bring the entire league with you.
Should lift all boats, you'd think. Up next on the programme, we'll set you up for the day ahead. You're watching Bloomberg TV. "40 minutes away from the opening bell. I have to say, a bit of a snooze. A welcome snooze, but a bit of a snooze. We're just about unchanged on the S&P 500. Bit of price action in the bond market, particularly the long end of the curve. Yields up another 4 basis points. It's just a grind, a persistent grind, a grind higher. 4.1% on a 10-year. Commodities pulling back by 0.8%, 75.27. Here we are going into the weekend again. Still waiting, Lisa, for a response from Israel to Iran's attacks.
That, to me, is sort of one big question mark. You could feel that every time there's some headline or some rumor out there. You see the response in the oil market and then a knee-jerk tick downward in risk assets. There is a feeling that there is something brewing, and people are trying to gird for whatever it might be.
One to watch once again going into the weekend. Going into the weekend and into next week. Here's the week ahead for you. At 1 p.m. Eastern, a little bit later this afternoon, we'll get remarks from Fed Governor McKee Bowman. On Monday, more Fed speak from Governor Waller. On Tuesday, look out for this. Lisa sitting down with the San Francisco Fed President Mary Daly. That's must watch. Plus, earnings from Bank of America, Citi, Goldman Sachs and United Airlines. On Wednesday, Morgan Stanley reports. On Thursday, an ECB rate decision. Plus, retail sales and another round of jobless claims. And we get results from Netflix and TSMC. Bramo, a lot to get through.
Yeah, I don't know which is more important, the earnings that we're going to be getting out, just to give a sense of what's going forward, or actually the ECB. Of all things, I actually think this might be one of the most instructive meetings, given the fact that they were counted out and then counted back real quick. And a question of, do they cut by 25 basis points? The market says yes. And how much more do they indicate they could potentially cut rates?
And if they don't, and we said this earlier, if they don't, I think that news conference is must-watch TV. How do you justify not cutting interest rates with the economy that they have over in Europe?
And what's the response from the euro? If they don't cut interest rates at a certain point, is it rate differentials that causes some sort of difference where you see a euro strengthen? Or is it suddenly, oh, wait a second, what are they thinking? How is that going to really support an economy that seems to be flat on its back?
I have to say, I've watched a lot of news conferences of the ECB over the years, and a lot of the time I finish with that response.
Okay, well, maybe this time too.
Many an occasion. Mike McKee's with us around the table. He's lived that a few times as well. Mike, let's talk about the Fed speak. Governor McKee Bowman, sole dissenter at the last meeting. Is she feeling a little bit better about that dissent with the incoming information of the last week?
We haven't seen any indication from her that she has changed her view that it is still okay to cut rates, just don't do so much. Now, she may have a firmer view once we get closer to the Fed meeting on November 7th and we've gotten more data. We'll see what happens. But it doesn't look like most of the people who've spoken have changed their views at all. And we did see in the minutes this week that the Fed was very divided at the last meeting. There was a big camp for 50, a big camp for 25, and Jay Powell gets credit for leading them to 50. We'll see what happens the next time. But each one of these people, we're going to go through hearing from them, and sort of the sorting hat comes out from Harry Potter and puts them in their camp. And we'll see then from there, where do they go? So we'll be watching you with Mary Daly to see whether she's a Hufflepuff or a
Gryffindor.
A Gryffindor.
All right, I'm glad. I'll ask her directly. I will not ask her directly. I am curious, though, as we parse through all of the Fed officials, whether they've kind of taken over less dominance when it comes to people's expectations for the economy. They don't know more than we do in terms of the crystal ball, and whether the economic data is actually a little more simple than maybe we're making it out to be, which is it's fine. And actually the consumer is doing well, and actually things are chugging along, and people want to worry and they don't see anything in the future, and so they don't like the vast lack of visibility. But otherwise, it's
well,
okay.
that's what Jay Powell was trying to get across at the last meeting, was we can do what we want to do because the economy is so good. We don't have to do 50 because the economy is bad. We can do 50 because the economy is good, and we're obviously tighter than we need to be at this point. That's their message for us going forward, and the data still seem to confirm that. We'll see retail sales next week. Will be interesting.
One to watch. What are you looking for?
Well, it's interesting. The economist consensus is for a small gain, but the Bloomberg second measure retail sales index, which you can find in the ECAN function, by the way, shows the last couple of weeks have been some significant declines in retail spending. So we'll see where that comes out, because people have been counting on a strong retail number for September to keep that 3.2%.
Will we just say that's hurricane related again, to do with Helene? How will we characterize that, particularly after the number we got from jobless claims?
It could be. That, here's the pitch for ECAN. You can break it down by category, and you can see what didn't sell, and that was some of the stuff that didn't sell. It is going to have an impact on retail sales. Both hurricanes are going to have an impact on retail sales. When you have no power, when the roads are all blocked, you're not going out and going shopping. But a lot of that is just delayed. So do we get it coming back? This is September numbers, so it probably didn't have a huge effect on this retail sales, but it will for October.
Mike, appreciate it. Have a good weekend. It's good to see you. Thank you, sir. Have a good weekend, John. Thank you. Up next, on Monday, Lori Calvasino of RBC is going to be joining us, Chris Harvey of Wells Fargo, Kate Moore of BlackRock, and Stellantis CEO Carlos Tavares. Do not miss that conversation on Monday morning. Bramo, that's a big one. It's a difficult time for that company and that industry.
The CFO out, suddenly the CEO. What do you have planned as the questions swirl over executive management?
You have a good weekend, Bramo.
You too, John.
Thank you so much. Thank you,
have
Mike.
a good weekend.
Thank you.
Thank you.
And to all of you at home, have a wonderful weekend.